such as the Pelamis Wave Energy Converter in Portugal and the Isla Limpet project in Scotland. But that hasn't stopped others from trying.
Companies are focused on testing projects out at sea, proving their durability, trying to raise capital and bring down cost. The sector hasn't really converged around one single technology design, and companies are kind of undecided about which design works best.
Finland-based AW Energy is a veteran in the sector. The first proof of concept of the company's device was made in the 90s after diver Rauno Koivusaari observed the strong back-and-forth movement of a hatch cover in a shipwreck in the Baltic Sea.
The waves are generated far from the coastline, so the wind blows on the surface of the water, causing the water particles to rotate, and that rotation extends deep down below the surface, and the waves can be very long. They can be several hundred meters long. And as they come into the near shore, this rotational energy turns into an elliptical energy, and eventually backwards and forwards, as you probably noticed if you've been swimming on the seashore in large waves, you're pulled in and out. That's the energy that we're extracting. There's a sweet spot where we deploy, so around 10 to 15 meters of water depth. That's where there's still strong wave energy coming in.
After years of research, prototyping and testing, the company has deployed Wave Roller, a 350 kilowatt device in the waters of Portugal. Wave Roller has an 18-meter wide and 10-meter high steel panel fixed to the seabed via a floatable foundation. The panel moves back and forth with the waves, capturing the energy.
It's submerged in the depth of 15 meters, so it's protected from the extreme waves. We generate electricity by capturing the movement with hydraulic circuitry in a machine room underneath the surface. That hydraulic energy we turn to electricity with hydraulic accumulators and hydraulic motors, and also a generator.
The Wave Roller has survived large waves at sea for over a year and delivered electricity via an underwater cable to the grid in Portugal. Meanwhile, the company has won a €2.5 million grant to work on an upgraded version of the Wave Roller, aiming to increase the electricity generation capacity to 1 megawatt. The upscaled device would have a bigger panel, 2 power takeoff units, and improved software to control the energy production.
We have taken into use a wave prediction algorithm that kind of tells us what kind of waves are coming into our device. That gives us few seconds to prepare for capturing more energy, and the difference in that is significant.
Our future plans are to deliver technology around the world. So I'm hoping we can be working on delivering technology to projects in Asia and also in the American continent as well.
Meanwhile, Israeli company Eco Wave Power is taking a different approach to capturing the power of the ocean. For the company's founder, Ina Braverman, developing new sources of renewable energy is a personal mission.
I was born in Ukraine in 1986, and 2 weeks after I was born, the Chernobyl nuclear reactor exploded, causing the largest in history nuclear disaster. I was one of the babies that got hurt from the negative effects of such explosion. I had a respiratory arrest and a clinical death. Luckily, my mother, a nurse, approached my crib on time and gave me a mouth-to-mouth resuscitation, which saved my life. I got a second chance in life and decided to do something good with it.
Growing up, Ina wanted to be a politician to positively change the world. After working as a translator at a renewable energy company, she decided to change paths.
Solar and wind energy were fully commercialized. There were a lot of amazing technologies implemented everywhere. I saw that wave energy, although it's an immense source of electricity, the biggest companies in the world are trying to develop wave energy with no success. And there was kind of a race going on in the world of who is the company that is going to develop a viable wave energy solution first.
In 2011, the then 24-year-old Inna co-founded EcoWave Power. Instead of installing devices offshore, the company's devices are attached to existing breakwaters, jetties, and piers.
Our technology is very cost efficient, especially in comparison to the offshore technologies, because we don't need any ships, divers, underwater mooring or cables. We install on existing man-made structures, and all our expensive equipment, the generator, the hydraulic conversion unit, the automation, is located on land just like a regular power station. This is the EcoWave Power conversion unit that has been operating in Jaffa Port since 2014 until 2020. Here you can see how the technology works. Basically, the floaters are going up and down and pushing the hydro cylinders, which transmit biodegradable fluid into land-located accumulators. A pressure is being built. The higher the waves, the higher the pressure, which is used to turn the hydro motor, which is turning the generators. The whole system is controlled by a smart automation system, which you can see right here. And in case of upcoming storms, the system automatically raises the floater above the water level and keeps them in the upward position until the storm passes.
The company has been operating a 100-kilowatt grid-connected device in Gibraltar since 2016, which is enough to power 100 households. Currently, Inna and her team are working on another 100-kilowatt project at the port of Jaffa in Tel Aviv.
The project will be also the first time in the history of Israel that wave energy will officially connect to the electrical grid. And our goal going forward is to expand it to all suitable breakwaters in the city of Tel Aviv and to supply a significant part of the city's electricity needs.
Today, engineers and entrepreneurs are still trying to crack wave energy. Globally, only a few hundred kilowatts of wave energy are deployed, compared with gigawatts of offshore wind. But the field has come a long way in recent years, and with the right engineering solutions, this new power source could eventually become competitive with more mature renewables like solar and wind.
I would have a lot more confidence in the success of wave energy companies today as opposed to like 20 years ago. But in the next few years, or maybe the next couple of decades, it will be more likely to be used in remote locations like islands that are otherwise dependent on expensive diesel power, or out at sea on gas decommissioning rigs, or for powering underwater autonomous vehicles.
So definitely, wave energy can compete with other renewable energy sources, but I personally believe that this is not a competition. In order to have a 100% renewable energy friendly world, we need all renewable energy sources to work together.
Who are all these people from?
So can you please tell me? I'm not going to... please wait.
You know, I've covered a lot of companies. I've covered a lot of Machiavellian companies where, you know, people play rough. I don't think I've ever seen anything on the scale of Nissan.
He is making you, but you act for Nissan. I mean, it's corrupt. The system is...
One of the most dramatic elements was Ravinder Passi's home being raided by court officials in Yokohama.
You scared my wife. You scared my children. I worked in Nissan for 16 years.
So Rav Passi's journey into the darkest recesses of the Japanese corporate world started when he was the general counsel, the highest corporate lawyer position in the company.
In the past few minutes, Nissan has revealed that its chairman has been arrested after allegations of serious misconduct.
He was tasked with investigating Carlos Ghosn. And he was told, conduct an internal investigation and get to the heart of the matter. And then along the way, he started to notice serious conflicts of interest.
He is one of the few people who knows an extreme amount of detail regarding the alleged crimes by Carlos Ghosn. And he's now ready to tell his own story on the record about some of the events that happened.
My name is Ravinder Passi. I'm the former Global General Counsel of Nissan Motor Co. Limited. And you could say, yes, I had a front row seat in terms of what was going on.
When Carlos Ghosn saved Nissan years ago, he was depicted in Japanese comic books as this hero, and now maybe we'll see comic books where he's the villain.
In corporate Japan, Nissan was quite an unusual company. It was led for 2 decades by a non-Japanese executive.
Well, Carlos Ghosn was a hero in the Japanese business world. If you had a global business celebrity in Japan and worldwide, it was definitely Carlos Ghosn.
In a country with few foreigners at the top, he stood out. But over the years, he saved Nissan from bankruptcy, allied with Renault and Mitsubishi, and turned the alliance into one of the most competitive in the world.
Yet as the years went on, you know, I think his ambitions changed a little bit. He started thinking about legacy plays, and one of them was to really tighten the alliance between Renault and Japan. And unbeknownst to him, there was a contingent of senior Nissan executives that were really felt threatened by that move. They really thought that they would lose complete control of the car company, and even in the government, there was probably a little bit of anxiety about a national champion in the auto industry falling under full-blown foreign control.
Carlos Ghosn was an auto industry leader, respected by many in Japan. Now he's in jail.
The arrest of Carlos Ghosn came completely out of the blue. This was in November of 2018. He was coming to Japan on Nissan's corporate jet for a regular executive meeting, and he was met on the tarmac by Japanese authorities who whisked him away to jail and charged him with financial misconduct crimes.
So what happened was that a power struggle ensued inside the company, and somewhere along the way, it was criminalized. By that I mean that there were allegations leveled at Carlos Ghosn about the way he reported his pay to Japanese authorities, the way he handled money inside the company, that in other contexts might have been a board action, might have been handled internally. A number of executives at Nissan decided to take this difference and take it over to the Tokyo prosecutor's office, and that unleashed a chain of events that would shake the entire auto industry.
So after Carlos Ghosn was arrested, Nissan launched an internal investigation into the events that led up to his arrest.
So Rav Passi was tasked with investigating Carlos Ghosn, and he was told, get to the heart of the matter, find out what Carlos Ghosn did wrong and bring it to our shareholders.
It's really complicated because you had various things coming out of the weeds. 2018, the investigation has started, and we become aware of matters in terms of conflicts, actions by certain individuals that cause some concern because things might not quite be what they seem.
So in our story, we really took a close look at Harinada and his role in Carlos Ghosn's downfall.
Harinada is one of the most fascinating figures inside Nissan. He's also a lawyer. He's originally Malaysian. Hello, Mr. Hadi. And he had a meteoric rise through the company and became very, very close to Carlos Ghosn and other top figures. He had a front row seat at all the major strategic deliberations at the company. And when he discovered that Carlos Ghosn, as his final legacy play, was going to tighten the relationship between Renault and Nissan, he made a decision to go against Carlos Ghosn. And he became one of the key figures that decided that Carlos Ghosn had to go.
Harinada was somebody who actually recruited me into the company, so I have a long-standing relationship with him, or did have a long-standing relationship with him. For many, many years, he was a mentor. I had doubts about the credibility of the process right at the start. Harinada had a plea deal with the Tokyo prosecutors. Now, that suggests he was intrinsically involved in some of the wrongdoing, or the allegations of wrongdoing, and it just didn't smell right, just doesn't sit right.
So there was a basic conflict of interest. In other words, Harinada had to deliver results to Japanese prosecutors to avoid his own criminal liability, and he's accusing and leading the investigation of Carlos Ghosn.
Some of the people who had been involved in the original alleged crimes were also looking into the affairs themselves. Ravinder Passi began pointing out some of these conflict of interest issues. And the reason for that is essentially his concern was for the company. If the company's own investigation into itself was compromised, that could lead to a very weak position in various lawsuits that it was dealing with across the world.
I had discussions with Harry, discussions with the statutory auditors about these conflicts, discussions with HR about some of these conflicts, because at that point, we reported into him. You know, at the time, everything was quite, as you can imagine, it was, we've got to do this, we've got to do that, we've got to move fast. But when you step back and look at some of these things, you just think, my God, what was going on here? Because me, members of my team, were being placed in immediate danger. Your chairman's been arrested, a representative director's been arrested. They both happen to be foreigners. And then now what we need to do, we're being instructed to do, is certain compliance professionals need to go into properties in Brazil, for example, and retrieve evidence. They've got to do it very carefully, because if they don't do it carefully, they're going to get convicted of criminal activities. And likewise, when a team of lawyers were commissioned to go to Lebanon. I mean, one of my immediate concerns was, why are lawyers from Nissan being sent to go to Lebanon to retrieve evidence? These are just lawyers, they're corporate lawyers from Nissan. You had revelations that a number of executives had benefited from share appreciation rights when they shouldn't have. I mean, you know, substantive amounts of money being taken by these guys when they weren't entitled to take them. And you do think, yes, how is this going to look later on? It's going to look quite concerning. So that triggered for me the sort of assessment that, well, I'm going to have to do something, because up until this point, I haven't put down on paper these conflicts and these issues.
So Rav Pasi makes a fateful move. He writes this letter to the board listing every suspicion he has in great detail, backed up by evidence, backed up by memos, of why this internal investigation had serious problems. He sends the letter to the board and it's crickets. He doesn't hear much of anything.
Nothing happened thereafter. Nothing at all. Just like it just gone into a black box.
And he began to suspect that there was a desire, even at the highest level within Nissan, to kind of sweep these conflicts of interest under the rug.
Unfortunately for me, I think, you know, again, with hindsight, people must have thought that this is the nail that's sticking out, and we can't have this. Within 3 days of me submitting that to the board of directors, that letter to the independent board of directors, I was removed from the Goan Executive Conduct Matters. I was then told that I could not attend board meetings anymore. And up until that point, I had attended every single board meeting. I was then also told that after 8 years of being in Japan, I'd be going back to the UK. It eventually transpired that I'd be the VP of Projects and Transformation, managing a team of 3. So you can imagine what this feels like at this stage. Almost an arbitrary removal from Japan, where I've lived for 8 years, had 3 children there, my family has grown up, and we've been settled there, having a few months earlier been promoted to vice president at a global level, to being almost demoted.
So Pasi was essentially being reassigned to get him as far away from the internal investigation as possible, and also to a certain extent in retaliation to some of the issues that he brought up regarding the internal investigation and Harinada.
What happened to Rav Pasi can be seen as a series of corporate humiliations. I mean, first of all, his immediate responsibilities were taken away from him. Eventually, he lost, the coveted general counsel title. But it didn't stop there. Toward the end of his stay in Japan, Rav and his wife were convinced that they were being followed.
During that period, I'd noticed that whilst driving my car, I'd have other cars following me. First time I noticed this was around mid-March, and I was driving, I can't remember where I was going, but this grey van, small van, just literally started following me. And I noticed that there was somebody in the car taking pictures. And lo and behold, we were absolutely being followed either by people on foot or other individuals, 2 or 3, normally 2 burly men in a car, different cars at different times, following us around. They were following the family as well. And, given I'd seen the Nissan security department behave in a very, very egregious manner with others in terms of following and surveilling, I was very concerned as to what they were doing and who they were giving this information to. Because if they're giving this information to the authorities, you do think, why? What's going on here? I mean, this is just not normal behavior.
And this all culminated in a rather dramatic event in the middle of 2020.
Who are you people?
Where Nissan had hired a legal team and had obtained an unusual court order from the district court in Yokohama
to basically do a search of his home and seizure of his corporate laptop and phone and other documents.
If you don't let us in now, we have to break this key.
So it's a pretty extreme way to treat someone who'd spent 16 years at the company.
These people have all come in. We don't really know who they are, apart from the fact that I've been shown a badge that says the Yokohama Court. And they're here to recover a laptop and a mobile phone. It was even more weird because I'd highlighted to the directors that certain Nissan executives were trying to recover this laptop and this phone whilst I was still in Japan. And I was very concerned because it had evidence on there that related to misconduct matters and other forms of inappropriate conduct. It was just another form of intimidation, another form of harassment, forcing me almost to leave the company and the country. Because once they'd retained and obtained these items, we were still followed, which, again, I just couldn't understand. What is the point of doing that? You know, this isn't a car company. This is not the KGB.
I think it's fair to say that Rav Pasi didn't have full battlefield awareness of all the intrigue going on at Nissan. I mean, Hari Nada is interesting because he's both charismatic and charming, and one of the most brutal corporate infighters one could ever run across.
This is a confidential company email, right? You should not have this.
If he had fallen into line, he would probably still have his job at Nissan, be paid very well, and continued his work.
A career that he spent 16 years building at Nissan is irretrievably broken. It's been smashed to smithereens. He and his family paid a huge price, certainly. But in terms of being able to sleep at night, I think, he's come out ahead.
I highlighted issues to the highest levels of the company so that they could be dealt with appropriately by those in charge. There was no response to those, and there was retaliation against me. What's really profound, like absolutely profound, is that none of your colleagues, I mean people who you have known for years, forget it.
Yeah.
You're on your own.
Yeah.
And you got to be ready for that. You've got to be ready for that. If you take it on anyway.
This is the awful truth. There's always someone in the family that's pushing it.
This lady does not deserve to be taken advantage of, especially at your age with your own grandchild.
Yeah.
My grandma is having to sue them. I'm testifying against them. Nobody's talking. They're one floor below right now. I get afraid to go on the elevator. It's sad that it had to devolve to this.
It's like a soap opera
It's a
to
very
me.
sad thing.
It's a family feud.
A family feud.
Here's a family that, on paper, you would think has the wealth that so many people seek, yet at the end of the day, it seemed to sort of rip everybody apart. My name's Tom Schoenberg. I'm a senior reporter here at Bloomberg News, cover financial enforcement. I was approached by someone close to the Schottenstein family and asked whether or not I would be interested in writing about Beverly Schottenstein and this case that she had against JP Morgan. And it was immediately clear that there was a great story here to be told. So I started just, assembling all sorts of documents that the family made available to me. That included a diary that Beverly had begun writing when she started having suspicions about what was actually going on with her money. Beverly obtained her wealth from the Schottenstein kind of retail empire that has at times included Big Lots, Value City, American Eagle Outfitters, DSW Shoes. Beverly's husband died, and at which point they sold off their portion of the company, bringing them an enormous amount of wealth at around 1990. Estimates of her wealth were around $90 million. She, for many years, had that pool of money being managed by outside advisors. Her grandsons in the late 2000s had both graduated and were becoming financial advisors. She gave them a little bit to work with, and over time, her grandson, Evan, became the trustee of her entire estate. Managing sort of family money is not a conflict. In fact, some ways in wealth management, it's kind of how you get your start. It's kind of the seed that you need to sort of get going in the business. But Beverly started having suspicions that something was wrong probably in around 2016.
Well, there were suspicious things, but taken separately without everyone talking about their own experiences, it was hard to really put it together.
She had written a check to her caretaker, Dawn, that bounced. So she went down to her local Chase branch to sort of find out what was going on. She wasn't getting paper statements in the mail, so she asked them to print out a number of her statements having to do with her checking account and her credit card account.
So we went to the bank and asked for the statements. And she got a whole year and going through all of them, page by page by page.
And it was there she saw all sorts of charges that she said she didn't authorize or didn't know about.
I was becoming very, very suspicious. I was starting to look in the money part, and that's what bothered me more when I saw that money was going, and I was not a big spender.
Around the same time, Dawn, she starts noticing Beverly's son, who lived in the condominium below her, came up with Evan with a shredder and started grabbing papers in her office area, including some with JP Morgan letterhead, and just started sitting at the kitchen table, just shredding documents over and over.
Yeah, they came in one morning.
They used to do it in the back.
Through the back door, and they brought the shredder inside. And then they went in the drawers in the office and took out all the papers, and they started doing it. I was very suspicious because I know you don't go around and destroying papers.
Beverly said that they had done this many times before.
That's when she said to me, Dawn, I'm going to write my feelings in this black book.
Diary.
And it's a diary, and she started writing. Each day she would write a little at a time.
Around the holidays of 2018, a package had arrived, a FedEx package, and in it were materials about a venture capital fund based out of the Cayman Islands. Dawn and some other family members take a look at this, and they see that Beverly is signed up for this fund to the tune of $5 million over the course of several years.
And that was really the beginning of it. That was sort of the tip of the iceberg when it became obvious that something was going on, that my grandmother really wasn't aware of this fund.
You know, Beverly started to panic. She got really upset and called, JP Morgan's headquarters in New York and asked for Jamie Dimon. She said she was told someone would call her back, but she says that never happened. She wrote a letter to Evan and Avi, and in there she laid out a number of things that were concerning her: unauthorized trading, the checking account. She had about $1 million worth of jewelry in a safe deposit box, and that her son Bobby had the key to that box, and that jewelry had gone missing. All this was kind of packaged in this, 5-page handwritten amendment to a will and trust.
There's such an evolving narrative about why the jewelry was taken. The only truth we really know is that the jewelry is gone. But why it happened, there have been a lot of different stories.
You just don't take your mother's wonderful things and hand it out.
And they emailed that note to JP Morgan to seize all activity on her account.
And it ended up setting off a firestorm after that. As soon as they got this email that there was a cease and desist and that she wanted to send her money and change brokerage firms, they were actually vacationing one floor below downstairs. They're there right now.
The next day, Beverly's in her place. The granddaughter's still in her place visiting. Dawn is there, and up comes Bobby kind of barging through the door. And he's screaming about what was sent to the JP Morgan. They're now investigating them. And he's furious, takes his mother and sort of puts her into a chair, gets pen and paper, and she says physically forced her to write a retraction letter.
They were pushing me around.
It was a scary time. I was really afraid too.
I had to take her to the doctor, and she did an x-ray because she was in so much pain.
The locks had to be changed. The phone number had to be changed. I really thought we were going to have to hire guards to be outside just for protection.
Oh, it was terrible.
Horrible scene.
Beverly brought her case before the Financial Industry Regulatory Authorities, usually known as FINRA. It took several months of hearings. She sees all sorts of transactions that's going on, hundreds of them that she claims that she never knew about, never authorized, but yet were logged in JP Morgan's files as having been direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots. Over the course of their time with JP Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as JP Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from JP Morgan. They issued an award of about $19 million. I reached out for comment, and JP Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son, Bobby, wrote her a letter, said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance, and asking for forgiveness from my grandmother, I don't think we'd be in the position that we are now.
Since the piece came out, we've received dozens of messages from people, many of whom are telling their own sort of personal tales of, kind of financial advisors gone bad, or family members who got control of an estate and abused, those within. Seems that it's really resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself, but at the end of the day, they did wrong.
It's a painful life lesson. Beverly taught them that you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce in Essex, a group of 9 traders, led by a guy called Cuddles, made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it. WTI this morning down more than 35%.
People maybe wouldn't have been so surprised if the oil price had fallen to zero, but the oil price went to minus 38. It went far lower than anyone had expected. And so lots of people in the market were saying, well, hang on, something else is going on here.
A couple of months later, I started to get wind through a kind of network of sources that a tiny firm in the outskirts of London had made a huge amount of money that day and potentially had some part to play in what happened.
The information we got was that 9 traders at Vega Capital London had made in the region of $660 million in one day. As a group, I think they made as much money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually done something that breached market rules in a bid to sort of push the market? And that investigation is ongoing. So Paul Commins is a trader who cut his teeth in the pits in the 80s and 90s. When everyone had a nickname, his was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, hundreds of thousands and millions of dollar trades by shouting at each other, giving hand signals, and then sort of scrawling on scraps of paper.
The culture of the trading pits in London was very influenced by the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. They didn't wear Savile Row suits. They were ordinary working guys who happened to have a talent for trading. And a lot of them came from Essex.
I think it was 400 traders in the pits, and Cuddles in his oil and gas pit was described to us as amongst the top 3 amongst that, was very successful and made very large amounts of money as a young man. But inevitably mechanization and the arrival of electronic markets was the kind of death knell for the pits, and in 2005 the IPE closed down.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions. But Paul Commins decided to start his own trading collective out in Essex.
Some of them are ex-pit guys, cut from the same cloth as him. Lots of them are actually sort of in their 20s, and they're his, drinking buddy's son, or they're his own kids' friends from football. They're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, to get into this.
Sweet, as they say.
If you were to ask someone in Britain how they would imagine a kind of Essex person, they would see someone who's maybe slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie-style accent. Not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Faden Boyce is a very wealthy place. You have to have considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. Anyone that covers markets is going to be surprised about that. You're thinking your BPs of the world or your Glencores, but it's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there had been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil was going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. They are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, as desperation increases in the market and trading volumes go up. Now at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37 and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to $700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. And the law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world, and when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they'd done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had has kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be that they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided. The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land, and they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year.
If you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they've done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now once again imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work, Nature Conservancy and many others see that the carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in the story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system, and you end up in sort of a race to the bottom, and that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. You know, we're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. You know, we need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
the Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
This is a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes! It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial, be like a sports car. Yes. We got up to about 108 miles an hour on that test. And it's a short run, it's about 500 yards or so, and came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was like, is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving, and most importantly, they've probably gotten off of one before, they've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are like the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But there's people that have the ability, the fortitude to stick it out, to see the game-changing platform here. Those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single supercity economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near-vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on- and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network. That in the end will make it possible to travel, for example, over a whole continent. Take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element, because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. In a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, Hart's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects, and the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure the different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. And I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright Brothers Airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for? And why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe.
On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them in the eye and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. You know, its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be proud of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's been super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $79 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. You know, every other form of fossil fuel hydrogen, you know, it can compete with it on price, it can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
You know, hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen, that actually this pollution-free all the way to the supply chain fuel is now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop
using
money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, it could be anything. Hundreds of billions of dollars getting ashed while we ash the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, we've kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial, it'll never be supplied in the quantities we need it, you know, blah, blah, blah. Now we know, let's take action. It's practical, it's implementable, let's do it now.
Okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, you know, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn the gas. At least they're pumping up carbon and methane into the atmosphere, honestly. Well, not that honest because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know
Mr.
which is declining in value.
You don't have enough of it, right, to power the world.
Yes, that's only because we haven't had policies to support it. If we had policies to support it 5-10 years ago, it would be everywhere. You'd see the global warming budget start to come down. Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. From Bloomberg's World Headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality. And he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the SNAM model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, the so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, $600. Today, $100, and we see it going down to $50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia's very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling cost of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick it's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. From Bloomberg's World Headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
The great sci-fi art of the mid-20th century teased a vision of the future with one distinct element in common: a life for humans in outer space. Whether vacationing on an exotic new planet or commuting to the moon for business, space travel seemed like it was just around the corner. Yet here we are, a half-century later, and only about 500 human beings have ever left the bounds of Earth's atmosphere. But thanks to a set of ambitious private companies betting on the promise of space tourism, that long-awaited future could be here sooner than we think. For most of the history of spaceflight, governments have been the prime force behind nearly every aspect, from planning to funding to crew selection. But as early as the 1980s, proposals for commercial space tourism began to emerge, along with innovative solutions for getting people there, such as the wild concept of sticking a 74-person passenger cabin in the cargo bay of a NASA space shuttle. Although various non-astronauts have been selected for missions over the years, true space tourism didn't happen until 2001, when an entrepreneur named Dennis Tito coughed up an estimated $20 million to hitch a ride with the Russian Federal Space Agency for a week-long vacation aboard the International Space Station. 20 years later, we're seeing a new contender in this final frontier of tourism: private companies.
It's becoming a private enterprise situation, still very high risk with a high reward, potential reward. But, government is really out of the business of flying people now, and it's really going to be companies like Elon Musk and Jeff Bezos and Richard Branson that do that heavy lifting. Commercial space tourism is usually about taking the non-astronaut, the private citizen, into an orbital or suborbital flight. So you get a short amount of microgravity experience, and you can float and take some photos. And then you come back. This was something that technology had gotten to a point where the private sector was going to make a business out of this. There are multiple companies that want to get to the place where they fly people into space.
The first of these is Blue Origin, founded in 2000 by Jeff Bezos. Using the autonomous rocket system New Shepard, a tribute to the first American in space, Blue Origin plans to launch up to 6 passengers at a time, offering a rarefied treat of 62-mile-high views and a momentary experience of weightlessness. Booking officially kicked off in May 2021, with the very first seat to be auctioned off for charity. Meanwhile, Richard Branson's Virgin Galactic has also been pursuing a viable form of suborbital tourism, aiming for a launch in 2022 once Sir Richard himself has taken a flight.
I'm hoping to be able to go to space. I'd love to be able to coincide it with the moon landing and go to space. So I've got the whip on the team, and we'll see how we go.
The company claims to have lined up over 600 seat reservations so far, including Justin Bieber and Leonardo DiCaprio. Virgin has projected that the final cost of the ticket will be at least $250,000, or roughly $50,000 for each of the 5 minutes or so of weightlessness that you'll get to experience. Although costly, both companies' offerings aim to make suborbital flight a regular form of adventure travel, eventually driving down costs at scale to expand the customer base beyond the orbit of celebrities and billionaires. The third major contender is Elon Musk's SpaceX, which has set its sights even higher on orbital flights, which are
a whole nother level of complexity and energy and danger. When you go suborbital, if you're just going to go up above the von Karman line, which is 100 kilometers or about 62 miles, you only need to get up to maybe 5,000 miles an hour to get up there, and you go basically straight up and then straight back down. You don't have the reentry heating that you would see coming in from an orbital. So when you go orbital, I don't care if you're a baseball or a battleship, you've got to go 17,500 miles per hour, not just 5,000 miles an hour. The energies involved are much greater. By doing that, SpaceX has gone another level up, and that's what they're doing with the Inspiration 4.
Visit inspiration4.com for your chance to go to space.
Inspiration 4 is the first planned all-civilian mission into orbit, slated to launch in late 2021. The crew will bring their own set of diverse perspectives and backgrounds and experiences to test how a group of different people, namely people who aren't professional astronauts, could fare in space.
Until now, astronauts have had to be physically perfect, and this mission is changing that. And so I feel incredibly honored to be representing those who aren't physically perfect. At age 10, I was diagnosed with bone cancer, and I was treated at St. Jude Children's Research Hospital. And I spent a year there undergoing intense chemo and also surgery that ultimately saved my leg. I now work at St. Jude as a PA, a physician assistant, and I work with leukemia and lymphoma patients. The kids we work with are so brave, and they are very excited to watch me go to space because this is showing them that, you know, they're capable of doing this as well.
Haley, along with 3 other crew members, will spend 3 days in space, orbiting the Earth every 90 minutes before landing back off the coast of Florida.
Well, when you think about access, the first astronauts for the United States came from the test pilot side. And so women weren't allowed to be a part of that. We have somebody in their 20s, somebody in their 30s, somebody in their 40s, and somebody in their 50s. And so there can be access in all kinds of ways, whether you're talking about age, whether you're talking about gender, whether you're talking about race and ethnicity, and all of those things.
The first time, people are going up into space and not sent there by a superpower like the United States or Russia or China. Well, that's like really significant. And you've got to be very thoughtful about it. The whole game plan right now is to make space like really affordable and accessible for everybody, so that you can have fishing buddies going to space someday. But the first is special, and so with that, we wanted to have a crew selection process that could make space available to everyday people.
Getting to space is only the first step for space tourism. The next challenge is what to do and where to stay when you get there. Axiom Space is planning to launch the first segment of a new commercial space station in 2024. Their $2 billion project, called Ax Station, will become the first free-flying private international space station. Or, to use a more consumer-friendly term, a space hotel. Axiom isn't the only company out to make your space stay a little more comfortable. Bigelow Aerospace has been building what they call expandable habitat technology, like their B330, an inflatable pod module that expands once in orbit.
There's even one attached to the International Space Station right now they've been testing. And you take it up and it's rather small, and then you inflate it, and it seems to be working very, very well. This is likely to be the first kind of tourist hotel that you're going to see up in space. First of all, it's easier to carry instead of this giant tin can with all of that. The inflatables are lighter. You can just blow them up, and they get a nice big size for about less than half the weight probably.
But even as space missions become accessible to civilians,
the risks of going into space are incredibly high. And you could die 1,000 ways that we can think of and 1,000 other ways that we can't think of.
This is Michelle Hanlon. She's a space lawyer at the Mississippi School of Law, focused on protecting humans in outer space.
Now, I'm not an attorney for any of the space tourists, so I haven't been privy to their private contracts. But I can tell you that the FAA requires certain waivers to be in those contracts. So, for example, the FAA says, well, we're not going to make you make your spacecraft to a certain safety level. We are going to make you, spacecraft operator, make sure that you inform your space tourists of all of the hazards that you know of. I imagine a very long waiver, all the ways you can die in space. And you have to understand that there's health risks, and you have to indemnify the US government if you are launching from the United States. So those are things that we know a space tourist has to sign and has to waive. So now let's go back and think about our space flight participants. The FAA calls space tourists space flight participants. They don't call them astronauts. Why is that important? If you're not an astronaut, there's no obligation to rescue you if something goes wrong. It's a lot of money to set up a rescue launch. If it can even be done, it's something really important to think about, and that difference as we cross this threshold from having astronauts in space to having real people like me in space.
And when we are able to make it to space reliably enough, there's still a host of other legal and ethical issues to consider before space tourism can truly take off.
There are so many gaps in space law that we are going to have to put in a lot of sort of basement ideas. And so, for example, the Outer Space Treaty is a treaty that offers principles and guidelines for state activities, for the activities of national governments. It doesn't talk about private entities. It doesn't talk about humans in space. So now if something goes wrong, so let's think about all the times hotels on Earth are sued, right? So slip and falls. You step on something in the bathroom, you sue the hotel, and it becomes a private lawsuit. because of the vagaries of international law, if something happens in space, well, boy, you can sue the state that launched your spacecraft, you can sue the company that brought you there, you can sue the hotel, you can sue the individual, you can sue every government related to that, because the way the Outer Space Treaty and the Outer Space Regime have set this up is that anything that happens in space first has to go through a diplomatic channel before you think about suing in a court of law. And so every single slip and fall in a space hotel is a diplomatic nightmare. And so we really need to figure that out before we start sending a lot of people there. You think about human rights in space. Here, we don't think about a human right to oxygen because it's kind of all around us and free. It's not in a space hotel. So what happens if something happens and the oxygen depletes? Who gets the oxygen first? And then, of course, let's not even think about the labor. How do you treat your labor in a space hotel where that person may be there for 2 or 3 years without coming back to Earth? So a lot of things to think about.
Space habitats are more likely in the near future to focus on research missions and be a home for experiments that can't happen as easily back on Earth.
Space hotels, I think they garner a lot of headlines and a lot of news, but at the same time, that's not the first thing that you're going to see happen. They don't offer the compelling business case, I think, that you'll see from a place that wants to manufacture pharmaceuticals or a new type of crystal or some type of filament or fiber optic cables and other things that you can do in microgravity. The things that are actually, a high value finished good, when you get that back to Earth and you sell it for a very, very huge profit margin, that's what's likely to happen in space, as opposed to having a real estate platform that you sell to a tourist. A space hotel is really interesting, and it will probably happen, but it's not likely to be at the forefront of space commerce.
Even if space hotels are right around the corner, don't get too excited about booking a trip in one.
It's not a cheap ticket to ride to space, and it's going to be, millionaires and billionaires and that sort. But at the same time, the point was made that in the early days of airline trips, that was also a completely unaffordable ticket for most people. Those people who flew were people of means, and over time it becomes affordable to the masses. And I think that's the goal for all the entrepreneurs in space as well, to get those costs down to a point where it's not $10 million or $5 million or $300,000 ride into suborbital space. When it becomes more like buying a first-class ticket to go to Europe from the United States. So that's the goal, and the question is, can we get to that point?
Given the immense operating costs of getting to space, it may be years, if ever, until space tourism becomes a profitable venture for any of these companies. Virgin Galactic, the only publicly traded company of the three, has had a particularly rocky year, initially riding on the momentum of a SPAC deal, but more recently beset by launch delays and major funders, including Branson himself, selling large quantities of their stock in the company.
Space is really, really, really hard, and it's an absolute cliche, but it's one that happens to be very true. It's just really hard to do. That's also the reason that you've seen the delays that, Virgin had talked about flying years and years ago. And it became such a crazy point that Richard Branson actually stopped talking about it when he was asked, because it was never going to be when he predicted. But it's not insurmountable. And, investors have stepped up because this is something that is doable.
Despite the astronomical dangers and costs of getting to space, it may ultimately follow the course of other once fanciful modes of travel.
Wright brothers having, what was by modern standards a very unimpressive first flight, at Kitty Hawk. I mean, you had less than 20 years later, you had your first airborne ambulances being used to save lives. Fundamentally, the world is a more interesting place when people can go and dance among the stars and such.
The lure of space is innate. It's in our DNA. It's that exploration bug. We are an exploratory species, and we want to go out there and see what's out there.
That vision that I had in 1969 of seeing normal human beings travel into space, it's finally beginning to happen. When you get a bunch of people up there and they can all see it for themselves, that'll create even yet another revolution in how we treat our planet and the way we think about it.
So while 2001 came and went without quite looking like Stanley Kubrick's ultimate space fantasy, 2021 might finally be the year we're catching up.
If you visit California, you might be inclined to go to Disneyland, or jump in your convertible and take Highway 1 up the coast, or maybe make a pilgrimage to Yosemite. All very fine choices. But if you're the kind of person who revels in our planet's extremes, then it's Route 395 that you're after. This one glorious road will carry you from Death Valley's desert floor to sky-high views of Mount Whitney. You can see the 5,000-year-old bristlecone pines, the oldest living organisms. Or the bizarre tufa towers of Mono Lake. And true to California's boom and bust spirit, you can saunter around the ghost town of Bodie. What a novel experience to find an empty American city where all the businesses are shut down. To do 395 upright, it helps to have a guide, and mine is a man named Jan, and his crew, Heron,
Let's tidy up first.
and Lemmy, the hardest partying dog of all time. Jan agreed to show me some of what 395 has to offer, but only if we agreed not to disclose any locations.
My name is Jan Swirstra. I'm an industrial designer out of LA, and I spend a lot of time camping and a lot of time in the Eastern Sierra. It's a place I love, and sometimes I'm known as 395 North because my Instagram account, and I don't like to be known as that, but I'm trying to use it to set a good example and do more with it than just social media.
Where did we end up camping? We got here late last night. I wasn't even sure where we are.
This is BLM land, right on the outskirts of National Forest, and it's one of my favorite places in the world. Basically, everything outdoors wrapped into one.
Yeah. Good thing about California, man.
Oh, man. We have so much national forest and public land that you can literally just cruise out and find a place to camp. It's ours.
What I wish was mine is Jan's sweet truck.
It's a 2019 Ford Ranger. Has about 200 watts of solar in it and a fridge, and has everything that an RV has except for a toilet, but just on a smaller, simple scale.
And you drive us around day to day in LA.
Yep.
And then just roll out when you want.
It's my daily driver. Handles great. And then when I'm done with work, I can just bail and go camping. So the camper basically has only what I need. Think of it as backpacking with a car.
Yeah.
The fridge has a couple compartments. This is just a kitchen box, stove, utensils, and a bunch of stuff. This one has just dry food. Then when you get inside, there's a bed. The bed flips up, so you've got tons of room in here. This awning is phenomenal. If you want to pull that over. That is cool. Let me just pop that up.
Sorted.
So, home on wheels.
Yeah.
This is my vacation house.
Dude, it's so nice, man. Even with his nomad lifestyle, Jan faces the same big question as the rest of us. Do the internet and smartphones have to ruin everything? When you find the super special, beautiful spots, is that you busting out a map and like looking where it might be cool to go, or is it word of mouth and just getting to know people, the locals? And
if I see a dirt road, I just want to go down it. So a lot of it's just aimless rambling. It's a desire to just see something. Check that out. For some reason, it's more fulfilling than getting a recommendation from somebody. Or there's tons of apps and websites now, road trip apps, camping apps. They've proliferated. The knowledge is accessible on the internet, right? I used to fight the geotags, and I would get really pissed off. Like, why are you posting this place? It's gonna blow up, it's gonna get trashed. Now I've realized that you can't fight it. The internet has just shrunk the world. So we're not gonna stop it. We're not gonna stop people from going there. So I'm a lot more focused in conversation now with trying to set a good example. When you go, pick up your trash. When you're pooping out in the wilderness, don't leave your toilet paper on the top. You know, make sure you follow, good steps for leaving no trace.
as a thank you for this quick guide to pooping etiquette, we made Jan, Heron, and Lemmy some tacos. And we all took in the night sky and knocked back a couple of drinks. Take that, Apocalypse. The thing about good times and serenity in 2020 is that they're fleeting at best. After we split up from Jan and continued on our way, smoke started to envelop us. The plus side was that our RV no longer smelled like feet. The downside was breathing. My man David here suggested that we try and outflank the smoke by cutting through Yosemite. Without a reservation, we had to talk our way in.
Yes, no stopping, no getting out, and yeah, no problem. We just wanted to get through.
It was a beautiful choice. Glad we got out of the smoke. Whoa, okay. But not quite as effective as we had hoped. Fast forward 4 hours or so, and we had managed to trade the smoky majesty of Yosemite for the smoky, look at it, strip malls of the Central Valley. We have made it sort of out of the smoke, all the way across Yosemite National Park and here to the gorgeous Central Valley of California. We're off to see a kind of surprising tech startup that is making some pretty strange machines to serve all the growers out in this region. So we're here in this near Fresno. This is California farm country, right?
We're just south of Fresno, a town called Kingsburg. So we're right in the Central Valley of California. Very, very large farming valley here. It's kind of considered the breadbasket of the world.
The Central Valley stretches out over about 20,000 square miles, and the farmers here produce about 1/4 of the food that Americans eat, including a whole lot of fruits and nuts. Tell me a little bit of the background of Gus. I know some of this is like a family business. The roots of this go back a ways. Tell me kind of like how we got to what's essentially like a startup, I guess.
Yeah, definitely. So the founder of our company is Dave Crinklaw, and he started the business back in 1982. He started with is basically with his dad was commercial spraying of trees and vineyards. Got to the point where our biggest challenge was labor, just the shortage of it, really. He was forced into innovating, and he had this idea for quite some time about doing a driverless sprayer, and it finally got to the point where he said, you know what, I either got to get out of this business or I'm going to innovate.
Organic or not, crops need to be sprayed, and this process has to take place a few times a year. This means hiring a lot of people to work long hours under serious pressure. And so, just like the tech bros to the north, Gus decided to solve all of its problems with robots. On this like labor point, you guys have set this up where you can have somebody in a truck and that one person can monitor, I think like 8 of these.
In order to operate Gus, you have one guy or girl that sits in a pickup and they monitor from a laptop computer. So that person is basically just watching all the vehicles on the screen. They can monitor up to 8 of them at a time while they're out there spraying in the orchard. And so that user interface really provides them with all the information they need to make sure that the machines are safe and that they're doing the correct job. So it tells them what speed they're driving, the engine RPM, the amount of gallonage per acre that they're applying at any given time. So if any one of the machines has an issue, it's going to send an alert to that laptop.
Much like a self-driving car, these beasts use GPS, LiDAR, and cameras to see and navigate the world around them. They also rely on pre-built maps of the orchards for extra guidance. Gus builds the machines right here, and then takes them out for robot training on this orchard next door. It's here that the company learns if the machines will behave and do as their software and human masters command. So this is kind of like this is a test orchard where you guys put it through the paces and work on the technology?
Yeah, so this is our test orchard right here. It's right by our building, as you can see in the background. So every new machine, as it comes off the assembly line, it's put through a commissioning test right here. We test all the sensors on the machine, autonomous computer, all the safety systems, make sure it's doing what it's doing prior to when it's delivered to a customer.
So what's it doing now?
So right now he's doing a test spray. So he's just turning the water on to make sure that the system comes up to pressure, spraying water out of the nozzles just to make sure it's all functioning properly.
Okay. It's got like a crazy turbine at the back, or?
Yeah, so it's basically just a big fan.
Okay.
And that fan's driven off of the Cummins diesel motor, and it just basically creates a big airflow.
Gus is already selling these vehicles to brave modern farmers. And people the world over have taken notice of its machines. And have you just sold them in the Central Valley or like throughout the U.S. or even overseas, or where are they going?
Yeah, so right now the majority of our machines are here in California in the Central Valley. However, we do have machines and customers in Florida, in the citrus industry over there, as well as Australia.
And I think you started selling them in like December of 2019.
Yeah, so we started taking orders early last year for the sprayers, and the first deliveries we made were in December of 2019.
Okay,
so.
And how much do they cost each?
So our retail price on these machines is $285,000.
So it's not a small investment, but I'm sure the regular sprayers aren't cheaper.
Yeah, I mean, we're honestly not too far away from conventional equipment on our price, and the main thing is that the return on investment is very, very quick due to all the labor savings and the increased efficiency. I mean, these machines, they just thrive. But basically what we're doing, besides this machine, this is our first machine. We call it Orchard Gus, mainly designed for your nut trees, as well as citrus and fruit. In the future, we're working on a few other projects. We're going to do more machines. One of them is actually a vineyard sprayer. So vineyards are much tighter spacing, so the machine has to be physically smaller. And then we've got our eyes on doing a lot of other innovating.
That right there, friends, is a Central Valley farmer putting his whole fruit basket on the table. Gary's TED Talk can't be far off. And with that, it was time to get back in the RV and to confront what happens when three men are bested by their own failings and the forces of entropy. Next on Hello World, we cruise into the Mojave Desert in search of a lunar lander.
We have instruments that we are going to deliver to the South Pole of the Moon in December of 2022. Instruments that are trying to scan the surface of the moon.
And hang with a test pilot who walked away from this.
Meet Betty. She lives by herself, but for the last few months, she hasn't been alone.
LQ, tell me a joke.
Did you hear about the claustrophobic astronaut?
No.
Apparently, he just needed a little space.
Most technology isn't made for 93-year-olds. But this woman is making sure that this particular robot is.
LQ, who are you?
She's researching the way we interact with machines. And if she has her way, robots will soon be a trusty companion for all of us.
My name is LQ. How can I help you?
As technology replaces old jobs, it's also creating new ones. I'm Aki Ito, and I'm here to show you the jobs of the future.
My name is Danielle Ishak, and I am a human-robot interaction researcher. It's really hard to intuitively design a robot meant for a consumer audience. You have to make sure that it's a robot that people want, people know how to use, and people value.
Danielle works for an Israeli startup called Intuition Robotics. Its U.S. office is here in downtown San Francisco.
Hello? Hey Danielle, it's Aki. Come on in.
The company is funded by a couple big names like Samsung and Toyota. Full disclosure, Bloomberg's venture capital arm is an investor too.
This is Ellie Q.
Can I take her out for a spin?
Please.
Ellie Q, tell me what you can do.
I am a proactive social robot designed for older adults. I can connect you to your family and friends, and even play music.
These features might remind you of the Amazon Echo, but you'd be missing the point if you compared her to a smart speaker. She's not meant to just be useful. She's meant to be a companion.
Why don't you take a break and have a drink?
And that's why she has a head that can nod and make other subtle gestures you might expect from a pet.
Through our research with older adults, we're finding that almost on a daily basis, we see that somebody tells her that they love her.
Really?
Or that they like her. Or that they miss
Literally,
her.
I love you?
Mm-hmm. They'll also tell her, I'm depressed, or I'm lonely. They'll open up to her in a way that they might not necessarily open up to a human because they don't feel like they'll be judged.
LEQ isn't on sale yet. But a prototype is already in the homes of about a dozen early testers who live in the Bay Area.
LEQ, tell me what the weather is today.
Danielle's job is to figure out what's working and what's not.
Sorry, please rephrase your request.
And she does that by visiting each of her testers twice a month.
How important are these visits to your job?
They're critical. We're building a product for people who we are not. I'm not a senior, and how could you know how to design for somebody if you don't do research? Because otherwise, you would just be designing in the dark.
Jobs like Danielle's are just starting to emerge. Until recently, robots were mostly in factories, separated from humans. But now, they're finally getting cheap enough, small enough, and smart enough to be in our homes. This has created a whole new challenge of designing robots that people will actually want to interact with. And that's where Danielle comes in. Her research has helped shape every little facet of LEQ, from the way LEQ moves to the way she talks.
It's a very special job, and it can be really hard, and it can be really frustrating, but at the end of the day, it's incredibly rewarding. And I think the most rewarding part about it is when I see the joy on the users' faces, like that they saw their feedback turned into something real.
Today, we've driven east of San Francisco to go see one of Danielle's research participants.
LEQ, tell me something interesting.
Did you know that Ronald Reagan was a lifeguard in high school and saved 77 people's lives?
Now, see, this is where a conversation is. She should open up and I should say, no, I did not know that. I expect her to be able to continue a conversation for at least a couple of comments.
Yeah. And why is that?
Why?
Yeah.
Because that's companionship.
When Betty was around Danielle's age, she was working with some of history's very first computers.
When I was finishing up my master's degree, I was working at Harvard in the computer lab when they were building Mark IV. A large room-sized computer. But now, this artificial intelligence stuff is amazing. LEQ?
Yes?
Schedule a doctor's appointment.
No problem. I'm working on it.
When Danielle brought along the idea of working with robotics for the elderly, I said, are you kidding me? Will older people connect to a robot? And she said, I don't know, let's research and find out.
Danielle grew up here in this suburb of Atlanta. Her parents spent much of their childhoods in Israel and met in the US.
We as immigrants, we understood that we might need to work a little harder. In fact, I feel that rather than taken away from Danielle, it gave her so much more. because she understood the fact that you need to run after your dreams and work really hard no matter what the challenges are.
School didn't come easily for Danielle.
I have dyslexia, and that very much affected my self-esteem academically.
The principal of the school did not recommend her to take advanced classes. She fought for it, and she got into it, and she did very well with them too.
Danielle's first job out of grad school was at X, the secretive research facility founded by Google. It's known for dreaming up all kinds of wacky, far-flung ideas.
Can you tell us about the moonshots you worked on?
No, I can't tell you too much about the projects that I worked on. I can say that I was working on robotics.
She loved the job, but wanted to work on something that would reach real consumers sooner. So she left X after a year and joined Intuition Robotics. She's been working in the field for 4 years now, and it took her a while to find her footing in a male-dominated industry.
I've gone to different meetups where there'll be like a circle of men with their like zip-up jacket with their like company logo on it and a beer in their hand. And I'll come in with lipstick and nobody wants to talk to me. This is my closet.
So at first she did her best to fit in, wearing a pair of glasses she didn't need and toning down her style.
So what's the kind of thing you used to wear to a conference?
Stuff like this, blousy things that make you look like you're 40.
But that got old after a while.
And what's the kind of thing you wear now?
Now it's like I just enjoy being kind of expressive and playful in what I wear.
Before we wrap up for the day, Danielle has one more LEQ tester to visit. Joseph is 97. And he's had the robot in his home for 8 months.
How are you?
I'm fine. How are you?
Good. How has Miss LEQ been?
She always tells me to take a drink of water at least 4 times a day.
So we added a whole bunch of new facts to LEQ.
Did you know that a cup of chopped red bell pepper contains more vitamin C than an orange?
Okay. What did you think of that?
Certainly, the print was, I could see that quite clearly.
What about this?
I can see that. LEQ, play music.
No problem. It will begin shortly.
By 2050, almost 500 million people are going to be 80 or older. And if current trends continue, more and more are going to be like Joseph and Betty, living alone.
LEQ, stop.
Today, both of them are doing okay. But some of Danielle's other participants have been struggling.
Is it kind of hard to leave them at the end of the day?
It is. Some of our testers are pretty advanced in the stages of depression through loneliness and isolation. And at times, I know that LEQ is cheering them up in their day, but I know that it's only part of the way. No source of artificial intelligence robots will ever be able to replace humans and human companionship or human care.
The key to Danielle's work is to embrace that very limitation of machines.
Robots should help humans do what they love, help humans interact with more humans, help humans in general. not pull humans away from humans, not take humans' jobs and leave humans without purpose.
Whether it's in our workplaces or in our homes, robots are soon going to be everywhere. And it's up to Danielle to make sure this robot-filled future leaves us just a little better off.
So don't be afraid. And if you are afraid, come and join us, because I promise it's a friendly place.
Times are tough. Jobs are scarce. It's risky to be outside and around others. Seems like there's very few ways to make extra money during a pandemic. So I guess I'll just hunker down and binge social media until this all blows over. Wait, don't these people make money? How do these people make money? Streamers, YouTubers, Twitch stars. How do they make money? Is it a lot? Is it a lot of work? I know, I gotta ask somebody in the biz, and I got just the guy. Austin John Plays.
This is your full-time job now, right?
As of November of last year, yes. This was always just kind of like a side thing. Like, any money that I made from doing my videos and whatever else, I never touched that because I didn't really think of that as being like real money. And then it started coming in more and more. And then it was like I hit my first day that I broke $1,000 and I was like, this is actually going to be money.
How did the YouTube channel come to be?
When the game Pokemon Sun and Moon came out for the 3DS, there was like things that I learned about the game, and then I wanted to just share that information with people. And at the time, I didn't have any way to capture a screen or anything, so I found like generic footage and I kind of put it all together with so much editing. And that video got 6 views. And then 2 days later, I made another one, and that one got 12 views. And then I just started pumping out more and more content, and people were like, this guy knows what he's talking about. It really just started building on top of itself, and then it was like, my channel really focuses on tips and tricks. So I play a straight 18 hours, and I'll finish the game or get to about the 40-hour mark, and then I'll make my first video. While I'm going through, I have a giant notepad and just scribbles everywhere, and I make these notes of like the things that stumped me, so I know the things that may stump other people.
What do you need to think about if you're building your YouTube channel? 1,
you need to do something that you're passionate about. Not that you like, not that you think you're gonna make money on, something you're passionate about. The other thing is something that other people are passionate about. It holds a special place to them. And third is, it needs to be something that people are gonna seek out information on. In order to enter into the marketplace, you either need to be better than everyone else, you either need to be faster than everyone else, or you need to be more accessible than everyone else. And you can't be more accessible because it's already on the platform. Granted, if you understand how the algorithm works, which is very similar to Google Analytics, then yeah, you can have a little bit of a head start. But if you're not doing it faster, and if you're not doing it better than everyone else, then why should anyone watch your channel? So my income as a YouTuber kind of breaks down to 3 different ways. 1, which is the bulk of it, which is ad revenue. Whenever you go and you watch a video and then there's an ad and then you wait 5 seconds and you hit the bottom right corner and then you go on to the next video, or a non-skippable ad, or the video starts immediately, you get the little banner ad at the bottom, or if you scroll down from the video, the first thing that shows there is an ad. Those are the 4 different types of ads that can appear on every single YouTube video. And all of them pay a certain amount. It varies on lots of things, like the country of the person who posts it, the country of the person who watches it, the time of year, where you are in the quarter, if there's anything going on with a reduction in ad revenue. Like, great example, COVID-19, companies weren't spending as much on advertising. So because of that, CPM went down. CPM stands for click per thousand. am using the Roman numeral for 1,000. And that means that for every 1,000 views, you get a certain amount of money. Now, on low ads, when I first started off, my CPM was 30 cents. So every 1,000 views, I made 30 cents. But then once I signed with an MCN and I started making more quality content and more engaging content, some of my better videos and certain times of the year, I can see CPMs as high as $12 to $14. And there's a big fluctuation between, you know, if I post a video when there's no ads being spent like January and February, that's the reason a lot of your favorite YouTubers and also TV shows don't post new videos in that time of year because ad rates are down. Why are they going to make content then? Instead, you're recording and you're bulking up for when ad revenue is higher. The second way that a YouTuber makes income is support, crowdfunding, things like that. When I first started off, Patreon was really the only option, but then they started rolling out supporters and members for YouTube channels. So whenever I have a live stream, you can click a button and then you can become a member, and then you get special icons next to your name. I believe they're called badges. Or on any video, you can hit the join button, and that helps support the channel. And then the third aspect of that would be merch. And for me, my merch has been somewhat basic. In fact, I'm wearing one of my t-shirts from last year right now. You have to endure the times that your first video gets 6 views, that you post it on Reddit and they say, shut up, and then an auto mod bans you. You have to go through that, because until you go through that and you discover why you're doing it, you're not doing it for other people, you're doing it for yourself. If you're not loving what you do, then it's not worth it.
Huh. So make a channel about something that I'm passionate about. Oh, sweet. I guess I can make the channel about that. Now, how do I grow an audience? How do I get popular?
It's all about diversification, right? You have to have a massive Twitter following. You have to have a massive Instagram following. You have to have a massive YouTube following. Of course, you have to be on Twitch, which is the key platform. But basically, any way you can get in front of your audience, you can engage with your audience, is going to drive those clicks, which ultimately drives the advertiser revenue that you get back from all of these platforms.
It's me and Dan playing video games and talking in a funny manner over them.
They're not just people who are good at games, they're actually people who are good at online engagement, online entertainment, first and foremost.
You have the right to remain stylish. Anything you wear can and will be used against you in the court of fashion.
The streamer is either very, very talented at the game. The best player in the game is generally going to draw a crowd because people like watching people who are very good. On the other hand, they're either very, very good or funny, charismatic, whatever it is on that side.
Oh, no.
You know, it becomes more of a show where they talk about other things outside of the gaming world, and gaming becomes really just a backdrop and an excuse to engage with that audience.
There were those weird, like, Ronald McDonald, like, straight to VHS movies. You remember those?
I'm personable, I'm chatty. I would kind of, you know, when boring things were happening in the game, I would ramble on about, you know, movies I'd watched or books I'd read and, you know, or conversations I'd had and stuff like that. And so I think being personable was a big part of that.
It's not just getting on and playing games. It's getting on and being an entertainer. You are putting on a show.
All right, now let me go ahead and grab the samurai sword that every gym has. Okay, he's dead.
To have a larger audience and to have that audience, I think, stay with you, you have to bring something extra. You know, you have to find your niche. You have to find what works and what connects with the audience and what makes them laugh and what makes them keep coming back.
You gotta make it a little more exciting, all right? Throw in a hanging bishop. Have everybody in suspense for a moment.
I think the real most important thing is to just get used to being on camera. Like in any sort of performance thing, is get used to talking on camera. You know, my first few videos were terrible, but because I sat down and did it for 6 to 8 hours a day, I just got used to talking and I got over that uncomfortable hump.
if you go into Twitch purely with the expectation that you're going to make money, make a job out of it, have all this growth, and it's going to be great, you're probably going to burn out prior to getting to that point, because there's very little payoff for a long time, right? Like multiple years generally before you really start to see a payoff. And so, you know, those first few times you're streaming, nobody is there. One person shows up every 30 minutes, says hi maybe, and leaves, right? Like, it's very discouraging, I think, for a lot of people. And so you have to be there just loving it. You have to love talking to yourself when nobody is around. You have to love just the game that you're playing, all of that stuff, because it takes a while. And I think a majority of people burn out prior to getting to the like profitable point of it.
And there you have it. My very own YouTube, Twitch, Discord, and streaming channels all ready to go live. It's a veritable social media ecosystem just on the verge of thriving. So don't forget to smash like and subscribe, and visit my Patreon for perks. Also, go to my merch page. And one last thing, stay cool, my friends.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
And a very good afternoon, everybody. Live from the Bloomberg Interactive Broker Studio, streaming on YouTube and on Bloomberg Quick Take. I'm Carol Masser, and yep, it's Monday, March 13th, 2023. Carol Masser, and as you know, Tim is on leave, so lucky for me, and I know she has been super uber busy, is our Bloomberg News Senior Markets Editor, Katie Greifeld. And Katie, I mean, it's an understatement to say it's all about the banks, a recalibration on Fed moves, a stock sell-off turnaround, and then we're just trying to figure out what are the further shoes to drop, if any.
That's the thing. That's the focus right now. And then you remember, we have CPI tomorrow. Oh. We're in the middle of like a really important macro stretch, and now we're also trying to wrap our heads around this contagion as well.
It almost feels like it was quaint last week when we were like, okay, next stop, CPI.
I know, right? Like, oh, we're in a little bit of a vacuum now. That was cute. I remember that.
Right, that's certainly changed. Lucky for us, and you really pulled him in early on, Bloomberg Opinions, Matt Levine, he's going to connect the dots when it comes to SVB. His column's always a must-read and must-listen to. And then we're going to get a global perspective on this. Mary Buckley is the interim CEO of IDA Ireland, the Irish government agency tasked with attracting investment into the country. I just love how we're going to look at this story from so many different angles today.
Oh, big time. And then we'll get back to some of those job cuts that we've been talking about for months. Really interested to hear her angle on that specifically.
Steve Ratner, just on Bloomberg TV. We're going to hear from him a little bit later on. His thoughts. Remember, he helped President Obama when it came to the auto bailout during the great financial crisis. So he's weighing in on this. And then we're going to take a look at Silicon Valley shivering a little bit as we saw SVB, that crisis, exposing some of the lurking systemic risks of the tech money machine. Having said that, Katie, tech stocks are rallying.
That's the thing. Tech has kind of been the safe haven over the past week, at least if you're talking just about the equity market.
It's a little wacky, that's for sure. S&P right now up about 26 points. You've got the Dow up about 138 points, and the NASDAQ up 151. All right, folks, more to come. Let's head over to our TV colleagues. Countdown to the close starts right now.
countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. About 60 minutes left to go here in the trading session. Romaine Bostic alongside Scarlett Fu. We're joined right now by our colleagues, Carol Massar and Katie Greifeld. Welcome to our audiences across Bloomberg Television, radio, Bloomberg Originals, and those folks streaming on YouTube. An interesting day here in the market, Carol Massar. We continue to see financial stocks really get decimated here, but a lot of buying going on right now when it comes to tech stocks.
Yeah, there is that, narrative out there that, hey, folks, if it is just limited to a few banks, look at all the companies and stocks that have been all of a sudden on sale as a result. So that's why maybe perhaps you're seeing some buying. Having said that, one group, while the rest of the market was largely down earlier today, we saw home builders really a standout from the get-go in the market. So we'll bring up the S&P 500 Home Builder Index. Now it's kind of keeping in market, maybe even lagging the certainly the tech trade today, but still up about 1.2%. Lennar, keep in mind they report earnings on Wednesday. They're up more than 2%. KB Home up about 1.5%. Toll was kind of interesting, not as big a rally today. Their 5-year senior CDS widening today, so that is somewhat of a bearish signal. But just keeping an eye, because Katie, I don't understand if things are slowing down, if rates are continuing to go up. That is part of the kind of rethink that maybe we won't get such an aggressive Fed, and that could be good for the home builders.
Well, maybe one of the reasons why we're not going to get a really aggressive Fed, take a look at financial conditions. We're looking at a Bloomberg index right now. As you can see, the past, 4 or 5 days have been dramatic in terms of the tightening that we've seen there. A lot of that coming from credit spreads, which have also widened dramatically.
Is this it, Katie? Is this the chart that they're going to walk into that building on March 21st and they're going to say, okay, that's it?
I like to imagine that, they're studying it right now.
There's a few days before we get to that.
It's a few days. There's a few days.
Also, there are a number of different financial conditions index. Which one does the Fed use?
It's a great question. That's what we would all love to know, because Powell has talked about this tightening that we've seen. But up until, last week, you can see we were loosening pretty significantly if you look at some of these markets-based measures.
Still a very fluid market right now here. S&P, Dow, and a NASDAQ all higher on the day. In fact, NASDAQ 100 up more than 1%, as is the composite here. Meanwhile, we should point out the Russell 2000 remains on the back foot, down about 1% on the day. Similar story for the mid caps, and a big part of the reason for that red is the outsized importance of financials in those indexes. The Russell 2000 weighted about 16% to financials.
How is it that we got this far without talking about bonds? I'm going to do it right now, because bond proxies are the best performers in the S&P 500, whether you're looking at REITs or utilities. In fact, utilities are having their biggest one-day rally since November 30th, and you're seeing yields come down. The 2-year yield at one point losing 59 basis points to fall below 4% on Thursday. It was above 5%. These are massive moves in a really short amount of time. And you're also seeing financials, of course, continuing their decline. But it goes back to that idea of the Fed is actually not going to raise rates next week by 50 basis points or at all. Then that re-rates the outlook for stocks as well.
All right, we talk about some of the individual movers here. Take a quick look here. We talk about all of the bank stocks on the back foot. A 49% drop right now on First Republic. PacWest down about 17%. And, well, they have a lot of company in that space. Keep an eye on some of the companies that had deposits in SVB. Of course, some of the reassurances out of regulators that they will be made whole, providing a little bit of a balance here. Roblox shares up about 4.5% here. And we talk about the interest rate sensitive sectors here. Duke Energy and the rest of the utilities all rallying. Duke Energy up about 2% on the day. I'll flip it up here and let's take a look at yields here. We never forget yields. A 2-year yield down about 50 basis points here on the day. You add up the movements that we saw over the last couple of days, and well, we're talking about 96 to 97 basis points just over the last 3 days. You haven't seen a drop like this over such a short stretch since Black Monday of 1987.
Which is why we are asking everybody, talk to us about this Treasury trade and what we're seeing in terms of rates increasingly in today's session, and as a result of some of the some of the banking crisis, if you will, that we're seeing and what it's doing in terms of expectations for what the Fed does. Having said that, Subhaja Rajappa, she's head of U.S. rate strategy over at Societe Generale. She spoke earlier on Bloomberg TV. Here's what she had to say about the Treasury price action.
This is typically the sort of price action you tend to see in the bond market towards the end of the cycle, where the market gets a little bit very skittish on the potential turn in policy. So especially given the fact that yields have risen so dramatically, our view has consistently been that the risk to yields are asymmetrically skewed towards the downside. And that's exactly what you're seeing in the price action.
And that's Subhadra Rajappa. She's head of U.S. rate strategy over at Societe Generale, earlier on Bloomberg TV. So can we assume that this is ultimately the rate action that the Fed goes into with that next FOMC meeting, or could things change?
Things can change.
I think it's really telling if you look at sort of the analyst notes that we've gotten in the past couple of days. On Friday, you had Barclays come out and change their Fed forecast to say that if they actually see a 50 basis point hike in March. Then you had Goldman last night saying actually they see no hike at all in March. I feel like that really encapsulates just this tug of war that's going on in the market right now.
And there's increasingly some pricing of trades where people are betting maybe there'll be an interest rate cut by the end of the year. I was just looking, Katie, and this is something I know you monitor very carefully, the fund flows into ETFs, and the ETF that saw the most one-day inflow yesterday, or it should be Friday, was BILL, which tracks 1 to 3 month Treasury bills, $462 million going into that fund.
I'm sorry, I'm confused. Is the fight against inflation over?
Well,
did inflation just
does CPI
because
even
everyone keeps
matter
talking
now
about
tomorrow?
SVB and the Fed's going to pause. I didn't know. Maybe the CPI report tomorrow will show that
That's a good
SVB
question.
apparently got us back down to that 2% target.
And isn't the easy money policy that we've had for so long what kind of got us into trouble in some of these sectors?
Well, that's a whole nother debate.
I will say, I was listening to BTV on Friday, as I do every single day. I think it was Michael Collins from PGIM who said that the focus has shifted away from inflation risk to the risk of something breaking, and that SVB is proof of that.
What's going on with Katie and the glasses? It's like a
You know,
Clark
I
Kent,
don't
Superman
love it,
type
Romaine.
thing,
I'm
or-
feeling a little self-conscious about it.
You
But
look good.
It
You're
works.
good.
You're rocking it.
Oh,
I
stop.
would take financial advice from you.
Oh, thank you.
It works.
I have none to give because I'm a journalist. But.
Yeah, but I think it goes back to a really important point that you just made, Katie. Our bank run's more important than inflation. Perhaps for now it seems that way. And there's no harm in pausing and seeing what else may come up and what other effects may result because of a year's worth of nonstop interest rate increases.
I mean, look, we know that we're not sort of in where we were in the past when we had these sort of runs, when we had these big conditions. But I think there is still a broader issue here that the Fed is going to have to discuss here. There are ripple effects, and we've already seen that here. It doesn't matter if you are directly linked to what's going on with SVB. There are ripple effects out of this that are going to affect the cost of financing, affect the flow of deals and everything else. And I think the Fed certainly has to weigh that.
Yeah, it definitely has an impact, no doubt about it. All right, guys, obviously we have lots more to talk about it. We're going to come back in less than an hour's time. We'll continue our cross-platform coverage, radio, TV, Bloomberg Originals, and also on YouTube. Beyond the Bell, we're going to count you down to the close on this Monday. Banks. We've seen banks under pressure. We know all the news. So let's just get right to it because Bloomberg opinion columnist Matt Levine is here in the house. We knew we wanted him to weigh in on this week's flurry of activity and calamity. So let's get to it. Matt is Bloomberg opinion columnist covering finance, former editor of Dealbreaker, an investment banker, Goldman Sachs, and more. He is here with Katie and myself in our Bloomberg Interactive Broker studio. So what's the most important conversation to be having right now?
Gosh, I don't know. I mean, obviously, the worry that people have is how far this contagion will go, right? I mean, we've seen a couple of bank failures, and obviously there's a lot of action in a lot of other bank stocks that make it seem like people are not fully convinced they're out of the woods.
Are we?
I don't know. I would have said on Sunday night that it looked pretty convincing that the Fed was going to step in to kind of prevent bank runs or depositor losses, but I think people are still worried about capital at a lot of these banks. I think that a lot of them, it seems like, are probably undercapitalized on a mark-to-market basis and might have to raise money, and like that's spooking shareholders.
So on Sunday night, I was thinking, who do I want to talk to? Who's the one person in the world that I want to talk to the most about this? And after Janet Yellen and then after Jerome Powell, I landed on Matt Levine.
I was third, really?
You were third, but I mean, that's my triple crown right there. Can I just tell you some of the narratives that I've heard about this, and maybe you can myth bust for me? The first one is that basically this was the fact that SVB had a lot of long-dated treasuries, that when they got hit with all of these, withdrawal requests from their depositor base, which I understand was mostly, private equity-backed startups, tech bros, et cetera. That's another narrative that I've heard thrown around, that when they went to sell these, that duration risk really came back to bite them. Is that the whole picture, or is that missing some nuance?
Oh, I think that's most of it. Yeah, I mean, I think they had a lot of duration risk in in a way that was not accounted for mark to market day to day in their balance sheet. So they looked, if you just looked at their financial statements, they looked pretty solvent. But if you drilled down into the unrealized losses on their hold to maturity treasuries, they looked a lot less solvent. Someone noticed, basically. It seems like the tech bro crowd kind of noticed that
all at once, and we're like, let's get our money out.
That's how it works, right? Like one person notices, and then they go to the Slack, and they all get their money out. So
Are they on Slack? Is that like the cool place to be?
I'm not in the cool Slacks, but my understanding is there might have been some Slacks.
I'm on IB personally. Okay, that leads me to my next question though. Why didn't they hedge against this risk? Isn't this, I don't know, I would think that if you run a bank.
Bank 101 perhaps?
Yeah, right? Like, was there any way to hedge against this at all?
Well, they need to make money, right? I mean, the thing that I think happened with Silicon Valley Bank is they got a ton of deposits in very short order over the last couple of years because all of their clients were just getting, huge, they say in their financial liquidity events. They were doing SPACs, they were doing fundraisings, they're bringing in a lot of money and they're depositing it at SVB. SVB kind of didn't have a place to put it, right? Like you need to take some risk with your money to make money to continue running your business as a bank. Traditionally, you take some credit risk. They, all their clients were flush with cash and didn't really need credit, so they ended up taking a lot of duration risk. You can't really hedge that in a way that, they could have been just buying short-term assets, but then they wouldn't have made any money, or they wouldn't have made enough money. Obviously, they were getting a little greedy and reaching for a little extra money, but they took interest rate risk because it's the risk they could take.
So, Matt, is there a lesson already we're thinking that we need either increased oversight that beyond the systemically important banks, or is this just a case of a bank that was poorly run?
Well, I think we definitely are going to see calls for increased oversight over these non-systemically important banks, and I think, obviously, it's because they're systemically important, right? I mean, if you look at the reaction to SVB, it was, if we don't, rescue SVB's depositors, there's going to be a cascading run on other banks. That threat, seems to have been kind of, reasonable. Seems to be true that there's a lot of worries about other banks. And, if you believe that threat, then the first thing you do is you rescue the depositors, and the second thing you do is you start applying the same regulation we apply to systemically important banks to banks like SVB that have always said they're not systemically important but turn out to be.
I think it's really interesting that even though you did have regulators step in with this backstop pretty much when everyone expected them to on Sunday night, and yet you look across the market right now, I mean, banks are being sold off like crazy, especially some of these smaller regional banks. I don't know, it seems to me it kind of marries with what you were saying about, you had all these tech bros in their Slack chat, and it sort of led to groupthink, this herd mindset. They all pulled out. It feels like that's still happening with some of these regional banks, even though theoretically the depositors would be safe.
Yeah, look, I don't know. I think that I don't know that there are runs on these banks. What we know is their stocks have gone down, right? And there are a number of possible reasons for that. One is that this is a problem that people were not focused on a week ago, and now the drama of this weekend has sort of brought focus to this problem. And so people who are maybe a little behind are saying, I'm going to sell my bank stocks. I do think also there could be ways this goes poorly for equity holders, even if the depositors are totally fine, with one obvious one being that if these banks are kind of less solvent than they look, and if regulation is coming to basically make them be more solvent, then that's going to mean a lot of equity raising and a lot of dilution for existing shareholders. So that's one possibility. But I agree. I'm a little perplexed by the price action because I would not have expected big runs on all these banks after a weekend of the Fed saying, kind of, we're going to do everything it takes to make sure that these deposits are fine.
But without that online chatter, you do wonder, and there's been a lot written about this, that if without that, would we be in this situation? Because SVB sold, right, some assets. They did what they needed to do to kind of shore up, or you don't buy that?
Well,
or do you think ultimately...
I kind of do. I mean, it's a bank run, right? I mean, the problem with a bank run is you have all these assets that will eventually pay off, and you have to sell them now, and you don't have enough money if you sell them now, right? I mean, if there had not been a run, they were sort of generally aware of this problem. They were rolling off these long duration securities. They were reinvesting it. They were, they would have been fine if they hadn't lost $40 billion of deposits in a day. I mean, maybe, right? I mean, it's not great to be balance sheet insolvent as a bank, but it's something that's happened before and that banks survive. But when you notice it, when there's a a big fast run, then like there's not a lot you can do about it.
So if I were in charge of a regional bank right now, if I were managing a portfolio and say, I don't know, I had a lot of duration risk, what should I do? Like, how should I go about managing that risk? Does that change now? Would the answer be different than it was a week ago?
How could it
A
not?
week ago, I would have said raise a lot of equity.
Okay, for sure.
But now that seems. Look, I don't know. I mean, my answer to your question is I might sit very, very, very still and hope no one notices me because there's not a ton you could do, right? I mean, like the problems that a lot of these banks that they're held in held to maturity accounting, where if you sell it, like you trigger, like the losses become more visible, right? You have to account for the losses. So you don't exactly want to do that right now. You probably could use more equity, but you don't want to go out and raise equity right now because, like, arguably that's what triggered the run in SVB is doing attempting an equity raise. So I mean, your best bet is probably what you're already trying to do, which is to like let that duration risk roll down and reinvest the money elsewhere and try not to do it again. But like if someone notices you, there could be a problem.
I'm glad that I only hypothetically run a regional bank, I gotta say.
TBD, give it a few years.
I mean, the other thing I would do is like, call up the Fed and make sure all of like the, make sure I understand the program, be ready to borrow from the Fed, being able to shore up your liquidity with all these new liquidity, provisions is probably helpful.
That seems helpful.
Ralph Schlosstein of Evercore was on TV earlier, and he reminded us of Warren Buffett's, one of his famous quotes, "Only when the tide goes out do you learn who has been swimming naked," and we're increasingly learning that. Are we likely, because of this unusual low-rate environment that we've been in for so long, there's going to be more exposure of some problems?
Yeah, I guess. I mean, like all the, there are a lot of banks who are in roughly similar situations. I also think that like it feels like this is a one-time transition from that low-rate environment to a normal environment. Like when rates go from like 0 to like 4%, like this gets exposed. The next move, I think you're going to see less of this because like the problem is you had to really reach for a lot of duration risk when like, Treasury bills were paying 0 and your deposits were paying 0. But now if Treasury bills are paying like 4% and your deposits are paying 1%, there's a lot more ways to make money as a bank without reaching for duration risk.
Just got 30 seconds. What about like commercial real estate exposure? Could be that another shoe?
Banks could always lose money on credit. I don't know. I mean, it doesn't have the same sort of like, doesn't feel to me like being as sort of like hidden and surprising to people as this as the duration risk that these banks have.
This was great. This was the best 8 minutes of my day so far.
See?
I mean, it's been a bad day, but this was definitely the highlight.
Imagine if it had been Janet Yellen.
I was just going to say,
does Matt move above?
This was pretty good, though. This was a pretty good third place, I gotta say.
It's not too bad to be in those top 3. Matt Levine, thank you so much.
Thanks
really
for having
appreciate it. Columnist with Bloomberg Opinion. Check him out on the Bloomberg terminal, of course, at Bloomberg.com. I'm Carol Massar along with Katie Greifeld. Just getting started on this Monday. So much more to come right here on Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 3:21 on Wall Street. We check the markets all day long for you here on Bloomberg Radio. Stocks are higher, and this Bloomberg Business Flash brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. Your small to medium-sized business could qualify for up to $26,000 per employee if you kept them on the payroll during the pandemic. It's simple and easy to see if you qualify. Learn more at getrefunds.com. And right now, the Dow is up just about 0.1%. The S&P 500, it is up 0.3%. That's about 11 points. And the NASDAQ up almost 1%, losing a little bit of ground from the highs, but still solidly higher. The yield on the 10-year, it is creeping higher off the lows, but still down on the day. 3.58%, inching toward 3.6% right now. Spot gold up more than 2%. Crude oil down almost 3%. A lot of things the federal government is doing to prop up sentiment when it comes to regional banks. There's making depositors whole. We've been talking about that. There's also this special lending facility the Fed has set up. Banks can borrow against the previous higher value of their assets and not against today's depressed values. There's also the fact that Fannie Mae has pulled plans to sell off a big chunk of risky mortgages. And sources also tell us the U.S. system of federal home loan banks is now ramping up the amount of cash it has available to deploy. And guys, this is a Depression-era backstop. They say the FHLB, the sources say that is, that they are seeking to raise about $64 billion through the sale of short-term notes. And that's a Bloomberg Business Flash. Carol and Katie, back over to you.
All right, Denise, so appreciate that. Well, our coverage and focus on banking continues, and where and how we might find additional problem spots. Our in-house analyst on regional banks back with us, Herman Chan. He is senior analyst for U.S. regional banks with our Bloomberg Intelligence team. He joins Katie and myself here in our Bloomberg Interactive Brokers studio. And then on Zoom in Chicago, Anna Coy, partner and national financial services leader at Whipfly. It's a global accounting, tax, and consulting firm that's been around for nearly a century. So curious to see what, if any, of her banking clients are saying. But let's start with Herman. Herman, where are we? What's the latest here? What do you think it needs to be top of mind for our investor audience?
Sure. So where are we? We are in a market that is very dubious about regional banks. When we first chatted last week, our view was that the SVB situation would be a bit contained because SVB is a very unique outlier type bank that took a lot of interest rate risk in their investment securities portfolio and was also seeing some deposit outflow from their startup clients. There's no other bank of size in the United States that does that kind of business, that structured their balance sheet in that way.
We know that.
We know that for a fact. But the market is extrapolating from what happened with SVB and taking a very dim view of banks that operated either tangentially or had the same sort of geographic focus or product focus. And so banks like Signature have been felled by this. Banks like First Republic and Western Alliance today are being pressured because they operate in similar markets and customers.
Well, that's the thing. When I was reading my email last night, I mean, I read it all day. It was kind of a double whammy. First, we got a headline that said the U.S. says SVB depositors will have access to all money Monday. That's good. The next headline that I read was that U.S. says Signature Bank closed today by state authority. So, I mean, it makes sense that even though, to your point, I mean, we sort of had an isolated case here, it does feel like there is this concern over who's going to be the next Signature, what's going to be the next surprising headline. You mentioned First Republic. I mean, nothing has been announced about them, but is that a name that we should be keeping an eye on?
The market's telling you it's a name we have to keep an eye on, for better or for worse. I think it's a bit unfounded. The bank itself is a very conservative institution that caters to high net worth clients.
It's down 54% trading.
That's amazing.
I mean,
and it has had one of the best credit quality type stories over the history of the company.
Wow. Anna, I want to bring you into the conversation. Remind all of us, what you guys do and in terms of the types of clients you have and what you're seeing in connection with this, I don't know whether to call it crisis, but certainly concern and worry in the banking sector.
Yeah, absolutely. So Wipfli is a top 20 financial, works with top 20 accounting firms that works with financial institutions. Anywhere is up to about $15 billion. So your regional sized financial institutions. And, we help them from compliance, regulatory, as well as, consulting around digital and other ways to help them reach.
So how are those clients? What's the conversation you guys are all having with those types of clients?
It's been around liquidity since the fall, and right now it's risk. What's on their balance sheet? How do they manage the risk, and how do they not be the tangential ones that go down like you saw with Signature or the discussions around First Republic?
Well, Herman, weigh in on that thought, managing liquidity risk. We were just talking with Matt Levine about managing duration risk. If you run one of these regional banks, how do you do that?
Well, the new Fed facility helps you manage liquidity risk. The whole issue, in my view, is that the announcements last night with the regulators backstopping the depositors of both SVB and Signature, and also coming out with this new liquidity facility should give the market confidence that the banking sector can manage this liquidity risk, because the banks can use their existing assets and pledge it to the Fed, and then get liquidity out to help support their depositors if they want to take their deposits out of the bank. That's the whole point of this. It seems like it's fallen on deaf ears that the market doesn't feel like the liquidity risk issue has been taken off the table.
Yeah, I do feel like officials, Anna, come on back. Do those banking clients that you guys have and customers feel like the government is going to be there to backstop whatever they need?
Yeah, I think the banks feel that way. I think the risk that we're seeing is a risk that maybe many didn't have top of mind before now. And that's social media risk. It's going around like wildfire, whether it's Twitter, Facebook, Instagram, you name it. And so how do you manage against that, even though it's a very conservative bank that they're talking about?
That's the thing. I feel like I've seen so many TikToks even on this, which is not necessarily a social media channel that you would expect this to be penetrating. But Anna, to that point, I know that this is impossible to quantify. It's sort of a thought exercise. But how much did this sort of herd think that we've heard around what happened at SVB, how much was social media, do you think, actually a contributing factor here?
I think it was significant, and I think we're seeing it still with First Republic. That seems to be top of mind and at the tip of everyone's tongues right now, whether it's founded or not.
Well, and this is where, going back to you, Herman, where you guys have to do the fundamental and critical research, look at the balance sheets and understand it. So is there, from what you are seeing, a true disconnect between the social conversations and the social narrative versus what the reality is on a lot of these regional banks' balance sheets?
Right. I want to pull it back to what Matt had talked about in his prior segment with you guys.
Levine, yeah.
And he mentioned the duration risk of the securities book at SVB. Signature, and to a much greater extent, First Republic has duration risk in its loan portfolio because they are mostly loan to high net worth customers in residential mortgages or home equity type loans. So the duration of those loans are about 10 years. And so those books are going to sit on the bank's balance sheet at fairly low rates because a lot of the mortgage activity that happened, as you probably recall, happened during the pandemic period when rates were zero. And so when the bank did all these originations at that time, they were at very low levels. And so you have the same sort of duration risk, but in the loan book and not the securities book.
Anna, my head is spinning a little bit right now, I have to say, especially after being plugged in for like 4 days straight. What do you expect the next 2 weeks, 2 months of conversations to look like with you and between the banking clients that you do work with?
Yeah, I think you're going to see a lot of folks going back to the basics and really looking at risk on their balance sheet, better understanding, where they have current risks and truly trying to manage what that's going to look like in the future. And so a lot of talk around not just liquidity, but overall enterprise risk management and, truly getting back to the basics of what they were as a financial institution.
Hey, Herman, just got about 30, 40 seconds. Do we have an understanding of kind of maybe a window, a time frame, like to understand when all the fallout should happen as a result of this?
Wow, that's a tough one to ansr.
Sorry.
I think we're.
I know you'd be living on an island in the Caribbean. I get it if you knew that.
If I did, yes. I think hopefully the market is being very forceful with what they're trying to tell the story in terms of First Republic and some banks like Western Alliance, PacWest.
So either they're going to say, "Hey, here's the reality of it.
Right.
We're okay," or there's some
or
cracks.
something is going to have to happen. So either way, I would expect something to happen in a very short order.
All right.
It's going to be fun.
I know. Strap yourself in, everybody. Get ready for the ride. Herman, thank you so much. Herman Chan, he's Senior Analyst for U.S. Regional Banks at Bloomberg Intelligence. Not getting any sleep right now because there's so much going on here in our Interactive Broker Studio. And Anna Coy, thank you so much. Partner and National Financial Services Leader at Whipfly, joining us via Zoom from Chicago. Let's get a check on world and national news. For that, we head over to our Bloomberg 1130 newsroom right here in New York City and Leslie Lado.
Thank you so much. The chair of the Senate Banking Committee, Republican Bill Hagerty of Tennessee, tells Bloomberg Radio financial regulators got a bid for the collapsed Silicon Valley Bank, but allowed the bid to fail.
And they want to come back and re-attack this. I think it's going to be very, very difficult, though. And I tried to remind them that there are many, many borrowers here, small startup firms, that are now without a banking relationship that has any certainty.
Hagerty says even though taxpayers are not on the hook for this, every bank in America is going to get an increased fee. The president's now going to ask Congress to restore regulation of smaller banks like the two that required the government takeover. Bloomberg's Irv Chapman reports from Washington.
Henrietta Trace, political analyst for Veda Partners, has been talking to congressional staff. She said in a Bloomberg interview,
"There was no chance of congressional intervention in terms of legislation passing. This is a contained bank crisis that is explicitly in high-tech sectors. It has no impact on the heartland, not really the problem of most of America, is really the perspective."
Trace said the Republican House majority is likely just to blame inflation and the Federal Reserve decisions to raise interest rates for what happened. In Washington, Irv Chapman, Bloomberg Radio.
U.S. Customs and Border Protection says a large group of migrants in Mexico tried pushing their way into the U.S. but were stopped from crossing a bridge leading to El Paso, Texas. A UN migration official says the movement of hundreds of migrants to the bridge may have been spurred by a bogus rumor that officials would allow families with children to cross the border to apply for legal protections from prosecution. The U.S. government's instructed migrants to use a mobile app to make appointments to apply for asylum, but the app has been overloaded and glitchy since the January rollout. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leslie Lotto.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 3:40 on Wall Street. We check the markets all day long for you here at Bloomberg. And stocks right now, they are actually higher as investors grapple with all the problems at regional banks and all the things the federal government is doing to prop it up. And for more, we're going to go straight over to the First Word breaking news desk for our afternoon call with Bailey Lipschultz. Bailey.
Good afternoon, Denise. Stocks are higher in what's been a choppy day as turmoil from the collapse of SBV drove a reassessment of the direction of Fed policy. The Dow is up 30 points, S&P higher by 10, with the Nasdaq's gaining 110 points. The U.S. 10-year yield is at 3.55%, and small caps are down 25 points. 7 of the 11 main S&P sectors are trading higher, led by gains in real estate and utilities, while financials and energy are the worst performers. Nasdaq biotechs are up 110 points, transports fall 200, semis rise 180, while the VIX is higher by 5%. Leaders in the Dow, Microsoft, Amgen, and Salesforce, while American Express, Goldman Sachs, and Dow Inc. are the worst performers. Regional banks plunged as traders weighed the fallout of SVB. First Republic Bank fell 55%, while Western Alliance Bancorp dropped 45%, and Metropolitan Bank sank 40%. Charles Schwab is down 10% after initially plunging as much as 23% after it sought to calm investors. And in deal news, Pfizer will buy cancer drug maker Seagen for $43 billion. Wrapping things up, Bitcoin jumped 13% in its biggest gain since November to top $24,000. Live from the First Word Breaking News Desk, I'm Bailey Lipschultz. Denise?
All right, thank you, Bailey. And to hear Bailey live breaking news over your Bloomberg, you just type Squawk Go on your Bloomberg terminal. And that is a Bloomberg Business Flash. I'm Denise Pellegrini.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's
the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just got about 17 and a half minutes left in today's trading session. Carol Master along with Katie Greifeld live in our Bloomberg Interactive Brokers studio, streaming on YouTube and, of course, on Bloomberg Originals. So let's get to it with Liz Young. She's head of investment strategy at the online personal finance company and bank. We're talking about SoFi. She joins us on Zoom in New York City. Hey, Liz, good to have you here on this Monday. A lot going on, kind of the understatement of the day. SoFi, also a bank. You guys are a platform. I'm just curious what you are all seeing in terms of changes when it comes to volatility, signs of stress, changes in user behavior on the platform. What's going on?
Well, look, nobody likes to go through a weekend like we just saw, and no consumer or business likes to hear the term bank run. So obviously there's been a little bit of a shake in sentiment across markets, equity markets, bond markets, banking customers, everything that we've seen. However, we do offer a savings account with a pretty high yield if you're a direct deposit customer, so that has helped our deposit trends to remain strong. We also offer yield on our checking account. So in this era,
so nobody's yanking?
We have not seen meaningful withdrawals. So right now things are looking pretty stable, and I think given the news that we heard last night out of the government, I think they've done a decent job of really stemming, and stopping the bleeding that could have happened if everything opened today still with no backstop. So, I'm not going to go as far to say that this was an isolated incident. I do not think necessarily that this was something that we should ignore or that, we've solved all the but I do think it's important that we prevented this from becoming a bigger crisis.
And Liz, I mean, it's interesting to hear you say this isn't something that we should ignore. But then you look at the stock market. I mean, I see the S&P 500. It's up 0.3%. Then you look at what's happening in the bond market, and you had the 2-year Treasury yield down by the most since 1987 at one point. So there's a lot of drama in bonds, not a lot of drama when it comes to stocks, at least for today. How sustainable is that dynamic?
I don't think the move in equities is sustainable, and I'll be very honest about that. I think that valuations are still pretty rich here, given what's going on in the environment. I think that today we probably avoided the biggest fear, right? The catastrophic fear that could have occurred if there were more bank runs. But if you look at just what's happened in the Treasury market and take that as a signal of how stable things are, you don't typically see this size of moves, 20, 30 basis point moves, 50 basis point moves in things like a 2-year Treasury bond. So it's really important to watch that type of signal and look at things like the fact that we hit a curve inversion between the 2s and 10s last week of over 100 basis points. The VIX is now back up to 26. I don't think that an equity market can chug along with a VIX at 26 or higher. Treasury market seeing volatility like it is right now. CPI coming out tomorrow. We have a slew of other data that we will get towards the end of the week. So this is not a time where, again, and I think I said this already, this is not a time where I would declare victory and say, we're out of the woods, everything is going to be fine. I think that this is a really fragile environment right now, and we're waiting to see what the Fed is going to do in the March meeting, and there continues to be a ton of uncertainty around that.
That fragile market, that fragility takes what kind of forms possibly in the next, 6 to 12 months?
Well, when the market is fragile and poised for indecisiveness, it doesn't take much to send it in one direction or another. What I would say right now is I think the risk is more to the downside because of where valuations are. I also think that there's risk in the investment grade and particularly high yield credit market because we have not seen spreads move like they normally would in a stressful environment. So I think that over the next 6 to 12 months, if you look out long term, let's say we hit some sort of big drawdown that occurs in the next 3 months, then chances are in the next 12 months, the market has recovered a bit of that. And you probably also in that time frame see the Fed back off, if not cut rates. We probably have economic data that has gotten worse and, we're either well on our way or maybe even in 12 months through some sort of contraction. So 12 months out right now seems like a really, really long period to wait. But I would say for a time when the market is fragile and not sure which direction to go, it does not take much to push it over the edge.
And you brought up high yield credit, and something I've been thinking about is if you look at ETFs in particular, HYG is the biggest junk bond fund out there. Short interest is something like 55%. Then you think about what we're seeing in the ARC ETFs on the flagship fund. You're also short interest is near a record. It's the same thing if you look at some of BlackRock's emerging market bond ETFs. Just broadly, it feels like there's this appetite for investors to begin shorting. Have you seen that? Do you understand that impulse?
Yeah, I mean, I've been talking about it. So, if you're shorting a high yield ETF, obviously the expectation is in line with what mine is, that I would expect spreads to blow out. I would expect there to be some stress in those markets. The challenging part is that it hasn't happened yet. There has not been a big credit event to tell the market that spreads need to be wider than they are. I think that there probably is something lurking out there, and we're going to hear about that as time goes on. I don't know where it is. I don't have a prediction about where it's going to come from, but I don't think this was it. I don't think that this SVB situation, number one, it wasn't a credit event. Number two, I don't think this was the big thing that is going to put stress on the corporate bond market. So I do understand absolutely the impulse to expect things to get worse there before they get better. I just don't know what's going to actually send it that direction.
Great comments and great analysis. Liz, come back soon. Liz Young, Head of Investment Strategy at SoFi, joining us via Zoom in New York City, looking at a 2-year note with a yield of 4.02, 10-year with a note of 3.53. And as we said, equities definitely off their lows of the session. We're up about 0.8% on the NASDAQ, up about 0.1% on the S&P. This is Bloomberg Radio.
company news headlines on Bloomberg Radio.
And from Bloomberg World Headquarters, I'm Denise Pellegrini, tracking all the company developments for you. And regional banks, well, they have been under some serious pressure today. Take San Francisco-based First Republic, for example. Trading was halted twice today. It is down now more than 60% as some depositors line up to get their money out. And video of all that drama makes the rounds on social media. And all the problems in regional banks triggering fresh discussion that investors might back off the rate hikes, including from Ed Yardeni, founder of Yardeni Research.
Yeah, I think they're going to have to slow down the rate hikes. May even have to stop here. I'm not quite sure that we're going to have a rate hike at all at this next meeting.
And Yardeni with us there on Bloomberg Radio and television. Meantime, a lot of talk about whether high inflation is really ready to come down after all. Some consumers are pretty optimistic. We get more on that part of our story from Bloomberg's Steve Rappaport.
Denise, U.S. consumers think inflation will drop sharply over the next year, according to a survey from the Federal Reserve Bank of New York. Respondents also said they expect the cost of food, gas, and other essentials will continue to rise, but at a slower pace. Median one-year ahead inflation expectations declined to 4.2% last month, the lowest level since May 2021. The survey also shows expectations for inflation 3 years ahead holding steady at 2.7%. Denise?
All right, thank you, Steve. And we're also monitoring shares of Pfizer and Seagen. They are both higher on word that Pfizer is buying Seagen. That's a $43 billion deal. And those are some of the company stories we're following for you here on Bloomberg Radio.
This is Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
All right, everybody, you are listening and watching Bloomberg Business Week on this Monday. Pretty busy Monday, as you know, as you've been listening. Carol Masser along, Katie Greifeld. First, we want to kick off with some comments by Pershing Square Capital Management's Bill Ackman. Katie, he came out and he said regional bank stocks are an, quote, incredible bargain right now, as long as the government does the, quote, right thing.
And of course, Bill Ackman was very vocal over the weekend that the government, that regulators needed to do something. And now it looks like, he's trying to take the other side of that trade. And he did say that this is not without real risk, of course, but regional banks offer very attractive asymmetry at the moment.
Yeah, it's interesting, right? Well, yeah, and I guess if, you take a look at their balance sheets, know their exposure, and if you are knowing that the government is going to be there, a lot of these stocks, these regional banks have definitely taken quite a haircut over the last few days from Friday to today. So.
And he did make an interesting point, too. This was all in a tweet. He said that the decline in rates makes this an even better investment. And that was something I was thinking about this morning. We were talking about duration risk all weekend. The fact that you're seeing bonds rally in such a big way. You have to imagine at the margin that's helpful for some of these balance sheets.
All right, the other story we want to bring you, this is, I think, our most read story on the Bloomberg in the past 8 hours. Taking a look at Charles Schwab. You and I were just talking about it in the break trying to understand, because this is another name that's been beaten up. It has rebounded from a record intraday decline after the company came out, and they really were like, we're okay. They've got enough liquidity, sufficient liquidity to handle any volatility following that collapse of SVB.
And we did hear the founder say that the firm is basically a safe port in the storm. And you had Piper Sandler commenting that this bank has ample liquidity to meet its client withdrawals. And you can see that really reassured investors somewhat. Schwab shares had been down as much as 23%. At the moment, they're down about 12%, which is still a lot, Carol, but it's not 23%.
No, and down about 32% in the last 3 days since all of this started to happen late last week. So continuing to track that in terms of what is going on. Interesting day. I am curious to see, Katie, if we continue to see some buying maybe into the close here, certainly on the equity side of things, although, as we just heard from our last market guest, she's a little worried about the equity side.
Shoes to drop.
Shoes to drop. I feel like those are the words of the day. This is Bloomberg.
Moving closer to these closing bells, full market coverage right here on Bloomberg as we take you to the bell and beyond.
Beyond the bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu. We're counting it down to the closing bell Here to help take us beyond the bell. It's a global simulcast with Carol Masser and Katie Greifeld. We welcome our audiences across Bloomberg Television, Radio Originals, and those folks streaming on YouTube. An eye on the equity market here with the NASDAQ, Carol, holding on to some gains on the day, but all the other major indices lower. The Russell, which of course has a huge component of bank stocks, down about 1.6% here on a day where we should point out Treasury yields, a 2-year Treasury yield, down 57 basis points.
Pretty remarkable, right? And such a change of tune from what we saw certainly last week here. And I'm just thinking about how many days until the next Fed meeting. What is it that will ultimately shape the Fed's decision, Katie, when they sit down to make the second rate move of the year?
And you have to imagine the CPI numbers that we're going to get at 8:30 a.m. tomorrow will play some factor in that decision. But I mean, if you look at the markets right now, it feels like CPI has really taken a back seat to just mapping the fallout from SVB.
Not even that, but also the PPI number as one. Then we've got retail sales later on in the week. How much of that really matters right now if there's something fundamentally broken in the economy?
I don't know. I mean, that's the whole debate, though. Is there something really fundamentally broken with the economy, or is there something just fundamentally broken with SVB and maybe the universe of companies surrounding that? And
but isn't that what we're trying to figure out, right?
Well, yeah. Well, and that's what the Fed is going to have to debate. I mean, I think whatever they were going to go into that meeting talking about, let's just say there's been a couple other points added to the agenda.
The other thing, though, and Katie, you brought this up too. I mean, and we all did. Like, we're still fighting inflation. We still have a ways to go, and that is certainly that makes it much more difficult remain for the Fed in terms of what to do.
All right, folks, we're getting the closing bells here in New York. The Dow Jones Industrial Average is going to finish the day down roughly about 0.3%. It's down about 80 points as we wait for these numbers to settle. The S&P 500 down about 6 points, or about 0.1% here on the day. And the NASDAQ Composite down higher by about 0.5% here. We should point out some breaking news crossing the wire right now. This coming out of the Fed, that the Fed is going to probe its supervision of SVB and release a review by May 1st. Remember, folks, there's been a lot of discussion here about why we didn't know what we now know, and the Federal Reserve planning a review of this situation that will be led by the Vice Chair of Supervision, Michael Barr, and that they will publicly release that report by May 1st. And guys, I mean, just not to get us off track here, but I just want to bring you back into this conversation because this really brings up a lot of broader issues, I think, about why SVB was allowed to have such a wide liquidity mismatch in a way that would not have been allowed if you were a Citigroup or a JP Morgan or a Bank of America, those systemically important banks. I know SVB wasn't in that category. Should they have been?
Well, I bet there's a little bit of a political debate going on, right, in terms of moves to expand certainly the oversight when it comes to regulators and more of the banking sector, if you will. And there is that thinking, right? We were talking with Matt Levine. Mm-hmm. We should expect that at some point, that this is going to be an expansion of regulatory oversight, especially as we think about shadow banking, the private markets. Yeah. There's a lot more that needs to be watched.
And let's not forget as well that the Dodd-Frank was actually watered down during the last couple of years. So maybe SVB would have fit that profile before, but after it was watered down, it basically fell out of that category.
Hey, Scarlett, I know you're going to get to some of the sector movers. I just want to point out the KBW Bank Index, the BKX, closing down 12% here on the day. Single worst day for that index going back to March 16th of 2020.
And you see that reflected here in the sector performances too, because financials, big cap financials, leading the way down for the S&P 500, which closed off by 0.1%. You see banks and insurers at the very bottom here, banks losing 7% on the day, insurers losing 2.9%, diversified financials off by 2%. So very much financials dragging the S&P 500 lower. On the upside, Lori Calvasino was just telling us that she's somewhat encouraged by the rotation into some of the sectors, like technology, for instance, real estate and utilities, bond proxies, both doing very well, up at least 1.5%. Carol?
All right, so let's get to some of the individual gainers, certainly in today's session. And what's really interesting is, it's not banks, folks. It's a lot of other names, and there's some special situations. Illumina, it is topping the S&P 500 and the NASDAQ 100, soaring after a Wall Street Journal report that activist investor Carl Icahn plans to nominate 3 people to that company's board. And so we are seeing some movement, certainly. That name was up almost 17% in today's session. Let's also go to CGen. This was another big one. special situation. Pfizer buying the cancer drug maker for $43 billion. So no surprise to see a pop in that target, up almost 15% CGen. And Moderna also atop the indices when it comes to movement to the upside. Cowen upgrading the biotech company to outperform from market perform, raising the price target on that name to 180 from 150. So that stock, Moderna, up almost 7%, closing at 147, almost 148 in today's session, Katie.
And if you look at the decliners, I mean, got to talk about the banks today because that pain was really widespread as we think about the contagion, at least from a market's perspective, of SVB. So let's look at First Republic Bank. Of course, it's another regional bank. It said on Sunday that it had about $70 billion in unused liquidity to fund its operations. But even still, I mean, you can see the shares down by the most on record. I also wanted to talk about KeyCorp. It's another regional lender, also in the Hurt Locker. Shares finished about 27% lower, so that is the worst decline since October 2008. And Schwab, of course, it's a brokerage firm. It also owns a bank. It's said that it has ample liquidity. That did seem like it soothed investors somewhat. Shares had been down somewhere over 20%, finished about 11.5% lower.
All right, let's get a quick check at yields here because, less than a week ago, guys, we had a 2-year yield above 5%. Right now, it is below 4%, and the drop today, 56 basis points. We haven't seen a drop on the 2-year yield on a basis point level like this going back to October of 2008, if you can believe it. One of the most amazing days that we've seen across equity markets and, of course, in the yield space as well. And now we go back to that breaking news that we just got. The Federal Reserve launching an internal review of its supervision and regulation of Silicon Valley Bank after that bank's failure. Bloomberg International Economics and Policy correspondent Michael McKee joining us right now to talk a little bit more about this. Mike, what do we know?
Well, the Fed is adopting what the Vice Chair for Supervision, Michael Barr, calls humility. And he says they will conduct a careful and thorough review of how they supervised and regulated Silicon Valley Bank. There's been a lot of critics over the weekend suggesting that the problems with the bank were sort of hiding in plain sight and they should have been recognized by regulators. So the Fed's going to take a look at it and find out where they went wrong. They say they will publicly release the study by May 1st, so it's going to be fairly quick. One senior Fed official today said to me, the banking system may be good, but there are always going to be bad banks, badly run banks, so there is definitely a reason to look at their supervisory practices and see how they can fix them.
Mike, this is one of the things that the Fed does, but how do you think about this? And then, of course, that upcoming Fed meeting on March 22nd, how do you kind of put it together?
Well, I think this goes beyond that Fed meeting. What will determine what the Fed does is how we get through the next 10 days in terms of the markets. And so far, so good. Some banks struggling today, obviously, but overall, the markets generally reacting positively to the bailout plan. And then what the CPI looks like tomorrow and to a lesser extent PPI on Wednesday. If it does look like there is progress still being made on inflation and the Fed is okay with the way markets are going, then it's a tough call. But if there's a jump in inflation, the Fed is probably going to lean towards still doing 25 basis points.
Right. That's a separate battle that the Fed has to fight, which I guess goes to the idea that the Fed does many things. We talk about it in terms of its monetary policy setting role, but of course it is a regulator to the banks. Give us an idea of the structure of the central bank. Is there a Chinese wall between its supervisory role and the monetary policy setting role here?
There's not a Chinese wall. It's two different divisions of the bank, but Michael Barr, the Vice Chairman for Supervision, bridges the two. And it's always been done, even before we had an official Vice Chair for Supervision coming out of the Dodd-Frank regulations. We had we had a member of the Fed board who oversaw the supervisory roles. That was Dan Tarullo before we had the Lael Brainerd in that role. So you do have a mixture of both. The Fed also always has a banker on its board. Right now, that's Mickey Bowman, who was a Kansas banker and worked in bank supervision. So there's a lot of overlap there.
All right, Michael McKee there helping us break this news here. The Fed officially announcing the probe of what happened with SVB and getting to this idea here that they will release that report by May 1st, guys.
Yeah, I think it's interesting, right? And I think at this point, you know, we're seeing all the regulators. We certainly saw it over the weekend that, you know, jumping on this, trying to get the transparency out there to investors and to the marketplace to hopefully calm things and hopefully be a much more informed market going forward. And this is certainly what we're grappling in, and that's certainly the environment.
And we should point out, this still isn't over. There's another headline crossing the wire. This attributed to the Wall Street Journal that there will be another auction with regards to the FDIC trying to offload some of these assets with regards to SVB. Again, that's attributable to the Wall Street Journal.
All right, certainly something and an ongoing story, as we all know, and continuing to track. All right, guys, that's a wrap. A lot going on this Monday. Our cross-platform coverage on radio, TV, on YouTube, and Bloomberg Originals Beyond the Bell. We will see you again, same time, same place tomorrow. All right, everybody, as you know, St. Patty's Day coming up.
I heard that on Friday.
We could all use a stiff drink, right? There's a lot going on right now. We also do know that we are front and center on what's going on with banks here in the United States. We did see, though, exposure and activity overnight. European equities, they tumbled the most since mid-December. They extended Friday's decline. Concerns from the banking center lingering despite measures by regulators to limit the fallout from Silicon Valley Bank's collapse. The world once again, Katie, looking at the global banking system. So we have a lot to talk about. With a global perspective is Mary Buckley. She's the interim CEO of IDA Ireland. It's the Irish government's agency to attract inward investment. She joins us here in our Bloomberg Interactive Brokers studio. Mary, as you know, a lot going on. Welcome, welcome. Nice to have you here with us. How are you?
I'm very well, thank you, and good evening, everybody.
Good to have you here. Let's start, though. There's a lot to talk about, and I know you're doing an event here with Bloomberg also overseas, but I want to start with the global perspective. The world once again looking at our global banking system, looking for cracks. How do you see it, and what do you think is the constructive conversation that we need to be having and that you might be having with your colleagues there at your agency?
Well, I think it's very early days yet for us. We're absolutely staying very close to companies in Ireland and we're assessing the situation. But at this point in time, I think from an Ireland perspective, there will be limited fallout from it.
So not seeing any kind of tightening as of yet or financial strains?
Much too early to say at this point.
What about sort of the psychological damage, if you will? Because, I mean, we've talked a lot about how this will affect Silicon Valley in the U.S. in terms of the tech scene. When you think about the global tech scene, the partnerships to be made there, do you think that this will have an impact?
We have a lot of tech companies in Ireland and they're operating very steadily there, and many of the largest players globally are based in Ireland. And I think that it's safe to say as well that Ireland would be seen as one of the most innovative economies in the EU. So I think from the perspective of that, from the government focus on innovation, and indeed moving on then to look at the very strong ecosystem that there is in Ireland, hence we have the tech companies here. I think that Ireland is going to be fine and it'll still remain a great location for tech companies.
Mary, it's interesting too, like you've been with IDA for a while, right?
I have indeed, yes.
So you've seen a lot of market cycles. No, I love folks like yourself who have seen different market cycles, different market environments. So if I think about the internet bubble or the great financial crisis, how does what we're going through here feel like what we've gone through in some really severe times in the past?
Yeah, and look, I think it's very clear, just to put some context on it, that we have over 1,800 overseas companies located in Ireland. And in tandem with that, there are about 950 American operations in Ireland. So very strong US relationships. Right. And I think it's very safe to say that, you know, Ireland is seen as a very steady location and a very secure location. And from that perspective, I can see that there is a huge amount of activity taking place in Ireland that is very, very positive. And the tech base of companies that we've seen lately, if you're to comment even on just in more recent times, some of the losses that we've seen in the tech base, Overall, it's about 1.4% of the tech employment in Ireland. And as you rightly said, Carol, we do have, just gone through Brexit. We've just come through COVID. And I think one of the things that it's very clear to see is that we're a very resilient economy and that the FDI base in Ireland is really strong. So if you look at even last year,
so foreign direct investment still coming in?
Oh, absolutely. Last year alone, we won 242 investments. And just as part of that, 167 of those investments came from the United States. But of the 242, 103 were brand new first-time investments. So I think it really demonstrates the value proposition for Ireland is strong. And in tandem with that, there's huge confidence in our existing base of companies as well. So I think from an Ireland perspective, from an FDI perspective, it's hugely important to the Irish economy, but it will remain strong.
And just to make sure I got those numbers right, so 103 of those were new investments, right?
Yes.
So what does the outlook for 2023 look? It seems like the bulk comes from the U.S., but beyond the U.S., I mean, where is the most opportunity?
Well, the bulk of the investments do come from the United States. And, we've just talked about technology, but I think it's fair to say that Ireland is very well diversified. So we have life sciences companies, both pharmaceutical and medical technologies. We also have financial services companies, and we have engineering and other types of companies as well. So I think across the board, we're seeing a lot of investments. And while it might be a little quieter this year because of the global environment that we're operating in, that will be the case right across the globe. FDI investments, they will be, slower this year.
Well, that's what I would ask, Mary. Wall of worry. There's things that we think about, and whether it's concerns about geopolitics, right? Or now we're worried about maybe what's going on with banks at this point. Other things we're worried about, just a global slowdown, global recession. If you had to kind of pick one big macro event that you say you're strong right now, but that is really top on your radar, what would you say it would be?
Well, there's so many things happening, across the globe at the moment. It's quite difficult to pick any particular one. We're certainly seeing, obviously for client companies, the environment in Ireland has been really, really strong. But they have, just like many other companies, they are coming through the challenges of inflation, of interest rates, and indeed the challenges of energy crisis and energy prices, all on the back of the conflict between Ukraine and Russia, and indeed because of COVID. And I think, again, last year was our best year ever in FDI employment.
Wow.
So again, I think it does demonstrate that resilience that I refer to, and the stability of Ireland, and the pro-business environment that's there. So I think that, regardless of the challenges, and there are many currently, it's referred to as a polycrisis. I think, if you look at Ireland, we have really been very, very industrious, and certainly from an investment perspective, Ireland is a great place in which to invest. And I think that's what our investors and our clients are seeing. Many of our clients are in Ireland, 50 years and longer. And I think, again, demonstrating again the innovation that takes place within the country has been hugely important to Ireland's success as well.
Mary, it's funny how narratives shift so quickly, because if this was a week ago, one of the first things I would have asked you probably would have been about AI. And we only have about a minute left with you. But when you think about, bringing innovation to Ireland, where does AI rank on that list?
Well, AI ranks exceptionally highly, and we have many companies that have come to Ireland, particularly to be involved in AI, and particularly from the US. We have a significant number of STEM graduates in Ireland. In fact, from the perspective of AI and STEM, the graduate from Ireland is very strong. It's the strongest in the EU on a per capita basis between the young graduates between the ages of 20 and 29. So right across the board, AI is really part of not just technology, but life sciences, financial services, and many of the companies that are in Ireland are actually focused on AI, and the education system in Ireland is really, really strong for bringing through that cohort of graduates to have the skills that are needed for a focus on artificial intelligence, which is really, really strong.
I do want to point out that Bloomberg is going to be hosting its inaugural European New Economy Gateway in Ireland in April in partnership with IDA Ireland. And I'm guessing they're going to be talking a lot about
Yes,
AI and innovation. So it's interesting, a longer term perspective, which is what New Economy does with its partners, and kind of gets above the daily and talks about long term. Mary, thank you so much.
It's been my pleasure. Thank you.
Our pleasure. Mary Buckley. She's interim CEO of IDA Ireland here at Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And it is 4:21 on Wall Street. Believe it or not, the NASDAQ did manage to close higher, but not so for the Dow and S&P. The Dow down about 0.3%, down about 90 points. The S&P 500 down about 0.1%, down about 6 points. And the NASDAQ, as I mentioned, higher, up about 0.5%, 49 points, kind of shrugging off all the problems with Silicon Valley Bank somehow probably looking at all the government has done to step in. But San Francisco-based First Republic, it was in trouble today. Trading was halted multiple times today. It was down at least 50% for much of the day, and it did close lower as some depositors lined up to get their money out, and video of that made the rounds on social media. And we do also have news from United Airlines. It says it sees first quarter operating revenue up 51%. That's slightly higher than the 50% it saw, and also sees first quarter total operating revenue higher compared to before. So we're monitoring that stock as well in the after hours trading. The yield on the 10-year about 3.54% right now. Spot gold, it's been higher all day, up more than 2.3%. And Brent crude, NYMEX crude, you name it, all the crudes closed sharply lower today. Looking at NYMEX crude, it closed down about 2.7%. And that is a Bloomberg Business Flash.
All right, Denise, thank you so much. Carol Massar along with Katie Greifeld live in our Bloomberg Interactive Broker Studio right here on Bloomberg Business Week, brought to you by Innovation Refunds. This is your daily reminder from Innovation Refunds. The sacrifices you made keeping your employees on payroll during the pandemic are not forgotten. Check the potential refund your small to medium-sized business may be eligible to receive through the Employee Retention Credit with no upfront cost. Learn more at getrefunds.com. All right, as you know, the yield on the 2-year dropping the most in decades. Stocks, including tech stocks, rebounding from last week's rout as the collapse of Silicon Valley Bank reverberated across trading desks around the globe. Turmoil has caused a swift reassessment, I should say, of the direction of Fed policy and a lot more. So let's get some perspective and thoughts on that. Back with us is Bloomberg New Economy Editorial Director Eric Schatzker, also Editor-at-Large here at Bloomberg. He's here in our studio with Katie and myself. So we have a lot to talk about, including an upcoming event that New Economy is doing. But I do want to ask you, you were in the trenches like a lot of us during the great financial crisis when we didn't go to bed on Sunday nights because the news just kept happening. How do you think about what's going on today against something like that?
Well, the first thought I had was, had the Fed known how much of a monetary tightening a bank collapse could have, maybe it would have let SVB fail sooner.
Nice.
This is not the great financial crisis. Come on. This is one bank, two banks, of course, because Signature Bank failed yesterday. And federal regulators, the FDIC and the Fed and the federal government in its entirety, acted very swiftly to put a floor underneath the entire banking system and, to a degree, the entire U.S. economy. If a bank can